Day two, the Brainerd mystery here. I've seen some terse notes from economic pros, like adults, with the appropriate parchment. They've got the appropriate jobs, basically saying Brainerd is nuts if she gives up the vice chairman. Discuss.
Well, I think that's up to an opinion, right? I mean, Lael Brainerd, her term is up at the Fed early January 2026, so this really won't do any harm for her. If she was to step into this role, it also sets her up nicely for a potential future for a Treasury Secretary,
yes.
Right? We know she was on the short list to be the Biden Treasury Secretary.
Okay,
he obviously went with Janet Yellen.
Lisa wants to get in here. What's the date calendar of a comfortable transition from Yellen to Brainerd? Inform us.
Tom, this is a question that, a lot of people talk about, but we don't know. The reporting we have is Secretary Yellen is committed to the job and she wants to stay on, definitely through the debt ceiling and through the end of the term. Potentially that can change, though. Obviously, things do change. I don't think you're going to see a shift at the Treasury until definitely after the debt ceiling drama is over with. So that brings us to at least the fall of this year.
There we go.
Let's talk about the position that Lael Brainerd could potentially fill if she is chosen. The position that Brian Deese has been in, and where he really was one of the most vocal about the SPR and what the administration was doing with respect to oil. Yesterday, Chevron reported that it's going to have a $75 billion share buyback plan. You've seen record profits from the oil majors. And the White House doubling down, saying it's an odd way to show that the company was trying to increase oil production. Is this gaining any traction at a time where the White House might be working against the market, pushing up prices with refilling the SPR next month?
Well, the president has been scolding the oil companies for months, so this statement, although it seemed maybe quite harsh for some in the oil industry, is not a surprise at all. Chevron's coming out with a $75 billion buyback. The administration maintains that they are reaping profits as Putin invades Ukraine, and that had a surge in energy prices. And what they want, and have they've been wanting for months, is for oil companies to be able to produce more so that they are less reliant on having to go ask neighbors. Obviously, this has been a tense debate in Washington. Republicans say that this administration has been at times hostile to the oil industry. There's new data that actually shows that the Biden administration allowed more drilling in their first 2 years than the Trump administration, but there's still the issues of Keystone Pipeline and the likes. But you still have individuals in Congress, especially obviously on the Democratic side, calling for things like a windfall tax on big energy. So this is something that still very much resonates in the West Wing.
So going forward, what's the policy going to be? Do you have a sense of the refilling of the Strategic Petroleum Reserve and what this administration sees as the most important kind of security issue there to protect against possibly another disruption?
Well, looking at today's prices, Brent crude $86.94, WTI $80.89. I don't think the administration will be filling up the SPR at these prices. I think they would like to wait to see there's a little bit more of a collapse. But the issue, of course, is that when you talk to analysts, all they see is oil prices going higher. And a lot of this just comes down to the question of how China opens. Is it a messy Chinese economy open, or is it going to be very much so a clean one? But we already are seeing higher demand on the roads in China. So it does look like prices are going to go higher. If prices go higher, it's going to be difficult to buy back the SPR, unless they want to do a solid for the industry, right? Higher oil prices, that's a time to buy back for U.S. oil producers.
Anne-Marie, thank you so much.
Politically toxic.
Yeah. Anne-Marie Horton, thank you. It's a toxic brew. Anne-Marie Horton, thank you so much this morning in Washington. I mean, I asked a dumb question here, and I looked it up on the internet, and there it is, Lisa. Okay, they emptied it to the lowest in 38 years, I believe. I don't even know what I'm saying here. How long does it take to refill it?
It's a great question.
Do you go to the gas station and stick in the pump?
Exactly.
And I got mixed stories here, but it's like thoughts and prayers, months and years.
Yeah, can you imagine?
I really don't know.
Can you imagine?
Where's Javier Blas with
Joe Biden going to the gas station and just filling up the SPR, like plugging it in? This is a real issue, especially if they're saying $70 is the bottom. Well, what happens if we don't get back there? Right? I mean, Anna Marie was basically just talking about that. This doesn't seem like an attractive price for them to go in and buy. They said they would start potentially next month. But if they don't, what happens if there is a disruption, right? And the vulnerabilities of that. And that's sort of the pushback that you hear from people.
Particularly if you want to win and, the politics of it. I mean, is of course all of it don't you just say, here's the plan, and you do a little bit every month? You know, that would be like the sane thing to do.
Well, but what would
nothing's
the
sane.
what would the implication be for oil prices? They've come down a lot. You are seeing these record profits for the big oil companies. $200 billion for the 5 big ones.
They starved for years. I mean, we know all that. I just did the $75 billion share buyback, which is something in the vicinity of 21% of their market capitalization. I'm not going to opine on if that's a lot of money or less. Apple's going to do a share buyback. I'll bet you it's somewhat equivalent with the profitability of Apple. Speaking out of turn here, but is there a do they have a moral obligation to return profits, or to the point of everyone, do they need to find the investment for the next marginal barrel?
Highly politicized aspect of the oil. I think that there's also this political aspect of the airlines as they come out with their earnings. Do they buy back their shares? I mean, right now what you're seeing is marginally increasing capacity for this year, which might be good news in terms of the supply-demand dynamic, but their margins are great. I mean, that's basically what you see other than Southwest. The margins are really good.
Mary Schlangenstein reporting here right now. American Air expects top profit estimates with full planes. Bramo left in Atlanta. There's
That was a different
headline.
one.
I mean,
Thanks
you
a
lived it.
lot.
It's out there, folks.
Yeah.
It's out there right now. But you know, John travels like rock star. I mean, he just effortlessly goes. Everywhere you go, it's a train wreck. You're always sitting in an airport.
Yeah, domestic is, going to be really.
I mean, you're living the
turbulent.
dream.
Oh my gosh, yeah. When your trip to Puerto Rico ends up in Atlanta. It's pretty.
Enjoy.
It's pretty
Get out
awesome.
Get out the beach chair on the
I actually
sidewalk.
did. I put on sunglasses. The
Why
kids
am I not surprised?
Kids were crying. It was
Red
great.
and green on the screen. Stay with us. I'm begging. Good morning.
We're investing in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store, so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. There's nothing closer than the phone in your hand.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Bloomberg Surveillance. Good morning, everyone. Jonathan Farrow in London, Lisa Bramwitz and Tom Keene in New York. Lisa, working overtime today on earnings. I'm going to get to the data check right now real quick. 19.23. Deborah Cunningham scheduled to be with us. She was brilliant on short paper. Her idea of the Austrian 97-year peace is the U.S. 2-year 4.15%. We'll get to Ms. Cunningham here in a moment. Paraphrase, Tesla up a solid $10. Give me the quote for TV here on Tesla. Help me out there, Chris. If you can. And then we got Intel coming up later tonight. Tesla up nicely, and we got Intel coming up later.
6%.
Up 6%.
Yeah.
Okay, it's a Muskian move. And then Intel coming out tonight, the 10-year per year return on Intel, a jewel of my youth, is 3.1% per year. That is the challenge of Intel. We're going to slow down here. Complete earnings summary. Lisa Bramwitz, go.
Well, I want to start with armchair analysis of the airline sector, because we've been getting all of the airline data out, and it is a tale of two airline stories. Domestic travel having a little bit more trouble. The business travel, the business class travel doing a lot better. And we've seen that with Delta. We've seen that with the others. Southwest obviously had their debacle, which led to a bigger than expected loss, is expected to go over to the first quarter this year. 2.6% decline. American Air, on the flip side, up 2.3%. And you can see that JetBlue, also domestic, down nearly 1% after earnings. But how much is that the story, Tom? Really, that business travel's back, people are going international.
Are they saying
that's where the money.
domestic business is back, or is domestic business Zoom Airlines?
When you have, well, domestic travel had been back, but that arguably is the sector that might be more affected by a decline in overall consumer sentiment and ability. The others that I'm looking at, Sherwin-Williams came out, and that's the paint company, and they gave some pretty negative guidance. Those shares down by more than 9%. And I do wonder how much this is also tied to home building and what's going on there, given all of the concerns around what's going to be happening with mortgage rates. Chevron, we were talking about them earlier with a $75 billion share buyback. Those shares up about 3%. And IBM, just talking to your point about Intel, where is the bar for Intel? Has it already been set so low? IBM actually hurdled over a lot of the expectations on both the actual profits and the guidance. Those shares lower by 2.3% because they outperformed last year. That's what people are saying. And so the bar was different. The valuation was a little bit higher. That, to me, is the takeaway there.
Are you done with earnings? You got more?
I'm done.
Okay, this is important. This is really important, folks, and this is about the humility and what we do with our guests here. When you have on a legit legend, whether you agree with them or not, like Ralph Ancampora or Liz Ann Saunders. Liz Ann was on Wall Street Week. She's like 14 years old. She was still in high school somewhere. But anyways, you've got these people there with a lot of experience, and what they're seeing is strategic plans and models blow up, like Mr. Roberts and Comcast now, with the losses they're publishing on Paramount Plus. They're brutal. $800 million, I believe, is the takedown of profitability there. Or like on Intel, which we all remember as a sterling, you know, John busts my chops about the Dow. It was the mother of all Dow stocks, just blown up. It's humbling.
Blow up your models too, because right now, is it cloud that's going to be on the front foot here? Is it Chat GPT and artificial intelligence? Where do some of the old tech giants go? For
is
the growth
Microsoft
in the
next Intel 15 or 20 years out? I'm not willing to say, but that's a humility you got to bring to this. Earnings, Helene Becker again. Helene Becker scheduled?
Yep, next
Helene Becker's with us as well. She's going to try and get Bramo a better seat at Hertzfeld when she's stranded in Atlanta. Right now, Deborah Cunningham joins us. Last time she was on, it was a public service, Global Liquidity Markets CIO at Federated Hermes. Thrilled you could join us this morning. Deborah, what's going to replace LIBOR? Is it working out? Do you have a day-to-day short-term piece that you believe in?
You know, we're getting more comfort with the BSBY index, Tom. It's you know, the Bloomberg short-term bank yield index, and it has some shortcomings in rapidly changing interest rate environments. So at a point in time when rates were going up very quickly or down very quickly, it lagged by a day or two.
Right.
But to a large degree, it has a lot of data points associated with it, a lot of different firms associated with it, a lot of different, input to that process. And it's actual trades for the most part, based on actual trades. So we're pretty comfortable
Right.
that can be something that is a good, bellwether at this point going forward.
What does your world out to your long-term 2-year yield, 24 months, what does it say new to Jerome Powell?
It says that his job may be slowing, the economy. It may be keeping inflation in check, but really he's not being heard that that's going to take more than just another month or two. So if you look at the Fed funds futures rate, it still is showing, a terminal rate of around 5%. So that's on par. That's kind of what they're telling us. But then where it gets wrong, where the market has it wrong, I think at this point, is looking into the second half of 2023. 25 basis point cuts, 50 basis points less by the end of the year, below the terminal rate. And I think Powell needs to, in his press conference next week, emphasize that longer really means longer. It doesn't mean longer in days and weeks. It means, months and quarters at this point.
Mohamed El-Erian just put out a column on Bloomberg Opinion saying that in order to get ahead of just what you're talking about, this market misperception from your vantage point of a Fed that's going to cut rates in the second half, that they should raise rates by 50 basis points despite the sort of groundswell of 25 next week. Do you agree?
I agree. I've said that before, but I don't think they will. Certainly the Fed speak, before we headed into the silent period now, was definitely, centered around 25 basis point, a 25 basis point increase. And, the focus of that was on the most recent inflation data. I guess if we had, maybe a PCE number that printed way out of line, that could potentially lead to 50. And although Powell didn't necessarily talk about 25 or 50, he didn't deter others from going the 25 basis point route. So I agree with El-Erian. I think that 50 would be a good wake-up call to the marketplace. I don't think that's what they're going to do, though, based on Fed speak.
Deborah, based on that, what is the bleed through into markets if you think this is what they should do and yet they won't?
I think, again, you've got to get to a point where inflation doesn't keep rearing its head. We have certain things that seem to be under control now from an inflationary perspective, or at least going in the right direction. But there are other areas of both goods and services that are not in that ballpark. And I think the danger is, we have to go higher in rates, and it lasts for longer than what the Fed is even looking for and wanting for. And what the danger is recession from that type of an environment.
Are you seeing any sense of a danger of a debt ceiling debacle in the short-term financing markets, or do you expect that to come later in the year or not at all?
Right now it's just a lot of talk. We answer a lot of client questions. It's confusing to investors in the marketplace. But when you look at the yield curve, there's enough uncertainty about what an X date would be, probably, between mid-June and mid-August. So 2 months worth of information that's uncertain at this point, that it's not causing huge amounts of issues in the marketplace. Where it mostly is hitting in the supply side right now. We have a lot of supply in the bill market, which is a great thing for short-term rates. But that will be cut back drastically, probably starting in March or April, depending upon what receipts are at that point.
Deborah, one of the great municipal projects of my youth was a Pennsylvania turnpike. It was a miracle of God through the rough Appalachian Mountains. Federated lived that out in Pittsburgh. Yesterday, we had a 26-year, $12.7 billion project launch at the wonderful Grand Central Station in New York. It's going to be a 22-minute ride from Long Island instead of going to Penn Station. Frankly, folks, Lisa knows this better than me. This is the vision that's out there in municipal finance, Deborah. Is the vision going to be there in the coming years for these big projects?
You know, Tom, I think the vision is good. I think the infrastructure needs of this country and certainly New York City are massive. And the municipal market will be a mode for financing that. Short-term munis, though, as well as long-term munis right now, are very subject to, you know, sort of technical factors. They still have a lot of cash that came through from a stimulus perspective. They are working on spending those and putting those toward projects. What I can probably tell you is, given that I travel the Pennsylvania Turnpike quite regularly at this point, weekly for sure, and it's still a project in the making. I can't believe that what did you say it was, a 26-year would be the right time frame for this project and its considerations.
We love in New York what they did with LaGuardia. They did it. What they do? Maybe rebuilt LaGuardia in what, 6 months? Something like that. Deborah, I'm kidding. Deborah, they got to rebuild the Pittsburgh Pirates. That's what they really got to do, Deborah.
Hey, we have Kutch back.
Yeah,
McCutcheon's back. That's a good thing.
Deborah, thank you so much. Deborah Cunningham with Federated Hermes there on a municipal project. I mean, you've lived this. Folks, for those of you like me that are really not on this, you're in Long Island. You got to go to the Upper East Side or the East Side Midtown. You got to go all the way over to Penn Station to then come back to your daily job. Is that right?
Basically, how do you make the New York City train system a little bit more like Switzerland or Germany?
$12.7 billion will get it done.
I don't know if it will. I think, though, that there is this real issue. How do you make it more convenient? But is there the will to do that at a time when people aren't going into the office in the same way?
Oh, that's a whole different story. Yeah,
but where are the revenues
absolutely.
going to come from if you don't have that groundswell behind some of that?
You know, I had a very important lunch yesterday with one of our senior officers, folks. Beverages were taken, and somewhere after the third martini, the person said to me, she said, what'd you think of Davos? And I said, James Gorman, work from home. You had the most important observation that I saw in Davos. That answer from James Gorman was on fire.
Basically saying you can't put the genie back in the bottle, but back to office is the groundswell, and that is where it's going at least 3 or 4 days a week. Yet, is that enough to get it done, right? But this is the issue, right? Because yes, maybe in the banking sector, but is that on a broader base? And then is there a shift to other locales rather than the big cities? This is a real question because a lot of people don't think we're going to go back to what it was pre-pandemic.
Yeah, my answer is I got an offspring. You know, she's got 4 degrees in Hollywood. Her major line is, may I help you? And she makes clear work from home ain't happening. She's got loads of friends, and they're just isolated in their homes.
Well, have you seen also the job listings? A fraction are work from home. The number of people looking for work from home, everyone. Basically, people want it, but it's not there anymore.
Lisa Abramowitz with James Gorman of Morgan Stanley. That was something. Stay with us. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. In Ukraine, President Volodymyr Zelensky thanked the U.S. and Germany for their promises to deliver tanks. The first German tanks could arrive within 3 months. Now Zelensky is calling for allies to provide other advanced weapons. Zelensky says Ukraine still needs planes and long-range missiles. Bloomberg has learned that the mayhem at the New York Stock Exchange earlier this week has been traced to an employee who left a backup system running. Now, that mistake triggered wild market swings involving more than 250 companies. Thousands of trades were canceled at a cost yet to be determined. American Airlines is out with an earnings forecast for 2023 that beat estimates. The carrier also posted fourth quarter profit that was better than expected. American says it's still on track to pay off $15 billion in debt by the end of 2025. And a change at the top of Toyota. The Japanese automaker is promoting Lexus president Koji Sato to replace Akio Toyoda as CEO. Now, Sato's job will be to guide the company through the challenges of electrification and automation. Toyoda, who's the grandson of the company's founder, will become chairman. The number of smartphones shipped in the fourth quarter fell by the most on record. That signals more pain for manufacturing hubs like South Korea and Vietnam. According to research firm IDC, phone shipments fell more than 18%. Turmoil in Apple's main Chinese production base may have been a contributing factor. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
For parents and anyone out there who still doesn't quite understand, what exactly are kids doing on Roblox?
Kids on Roblox aren't just playing, they're learning, they're hanging out together. When they can't be together in real life, they're hanging out on Roblox. They could be playing hide and go seek. They could be pretending they're running a store or a pizza parlor. They could be making the next big game or adventure. So it's really a wide range of things, and it involves doing things together, pretending you're together.
Everybody is talking about the metaverse as something that's going to happen in the future, but there's an argument to be made that Roblox has already built a metaverse. What do you think?
I think we've started. There's still so much innovation to be done, and there's so much invention to be done in this category that it's mind-boggling.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
From the world of politics to the world of business, Balance of Power with David Weston brings you news, analysis, and insight from and about politics power players. Balance of Power, weekdays on Bloomberg. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
You're in aviation, despite all the macro headlines, it feels like really, really as good as it's ever felt. In terms of our demand. And you combine that with supply challenges, things just look really good.
The pilot, Scott Kirby, he is of United Airlines, where he has piloted himself by many opinions to be the #1 performer in the U.S. aviation market. That's open to debate, but good to hear from Scott Kirby here across the Bloomberg network. Without question, this is the interview of the day where we're going to lean forward. I'm going to lean forward to the market. Look at Lisa. Look at the market. I turned away to see about a Google, Google flight, see where I'm going in Europe. The market goes up while I turn away.
That's been the shift.
3 days in a row.
Yeah, exactly. That's the point of travel. The gravitational force seems to go up.
Bitcoin above 23,000. I'm getting out at 25,000. Right now in airlines, I'm going to be very quick here because Lisa's really pumped up on the earnings that we're seeing. Helene Becker is with us, senior research analyst at Cowen, barely describes it. She and Kai von Rumer owned the franchise for decades at Cowen, and she provides leadership forward. Helene, I've got an answer. I use as a proxy New York to Paris, but even that price is down from the insanity of 6 months or 8 months ago. It's still stupid money, but it's less stupid. Is international starting to rationalize in the aviation business?
We're seeing, Tom, very strong international business travel. Less so maybe on the leisure, but I suspect leisure travel will pick up mid-February and then increase through the summer months. The demand is still very strong, and the further we get away from 2020, the more comfortable people feel about going outside the country.
Helene, how much is this a story of international travel just to compensate for what we saw versus a wholesale return to the way it used to be?
Yeah, I think, so I think there are two things going on here. The first is with respect to supply chain, our supply chain issues, right, from Boeing and Airbus being delayed on delivering aircraft. So you don't have a lot of capacity coming in, which props up price. But then on international business travel, after all these Zoom calls and people taking calls at midnight or 1 a.m, I did a call with a client earlier this week, and it was midnight in his time zone. I don't think that can continue indefinitely, and I think you're going to see an increase in international business travel this year. And especially, as more people feel comfortable traveling and COVID becomes people continue to think of it as being more endemic.
So, Helene, what is the new model? Is it basically having half the plane as business travel and the rest sort of sandwiched into the back as you try to get some sort of profitability overseas, and then domestic travel just the ongoing mess that it has been?
Yeah, so I think, to your point, I think the front of the cabin is going to get bigger in the sense of business travel, that cabin, and then you're going to get a bigger premium economy. And when you're thinking about long haul, it's the old lean back seats, the reclining seats versus the lie flats. And then you're going to get a smaller section in main cabin. And what we're seeing in terms of pricing, to Tom's earlier point, is the prices that would have been in main cabin before pre-pandemic seem to be a little lower, but prices in premium economy seem to be equal to what business travel prices used to be, and business seems to be more like the old first class pricing. So I feel like the price points are going up, and the mix is shifting, which is good.
Helene, you're killing me. True story. My father died on a 12-hour notice. I had to get on a plane, and I flew economy for the first time since time began. The seat was so small, I flew, Helene, to Portland, Oregon, nonstop, sitting on the edge of my seat whole way.
Okay,
it's a joke.
So then there's this issue, right? I've travel economy all the time, and there's the economy, and then there's the economy where you have to buy a soda for your kids if you want them to have any sort of drink on a 4-hour flight. I'm just wondering, Helene, for the discounters, whether it's JetBlue, which was traditionally the front of that, or Frontier, which I was talking about, what's the future for them if the prospects of domestic travel seem to be diminishing with the economic cycle?
Yeah. So Tom, I'm sorry about your dad first, but the other thing in terms of the outlook for those guys, they're going to slow their growth. They're going to have no choice. They're not able. It's not the hiring part, it's the retention part that's an issue. And then the aircraft, they have to keep growing, and they can't get the aircraft. So I think there's always going to be a market for a deep discounter, right? There's a market, if you think about hotel chains, there's a market for Ritz, and there's a market for Motel 6. And so I think you're always going to have that differential, and I think people will, who've gotten used to traveling, will continue to want to travel because that's what they do, versus buying lots and lots of things that they don't really need anymore. So I think those guys will be okay. I just think the growth will slow, and I think American, Delta, and United are going to see very strong international growth and growth in business this year. And I would just pivot as I'm thinking about investments to those names.
Helene Becker with us, folks, on radio and television. Thrilled to have you here on a big earnings day. She is with Cowen. Helene, just for the record, I keep a track of the business to economy ratio of a given flight from LA. It was 9-to-1, which I never thought I'd see. $9 of business ticket for $1 of economy. It's down to 6.3-to-1 right now is my biz econ ratio. That's Newark to LAX, and everybody else has their other ratios. With that said, what is the domestic constraint for Kirby, for Bastian, and the rest? Is there constraint gates? Is it new airports like the magnificent new LaGuardia? What's their biggest headache to get us back to some kind of normal 36 months from now?
Yeah. So the biggest one is infrastructure issues and the fact that at the busiest airports, there's just no space physically to put more aircraft, and we're not building more runways. Look at Newark Airport. The two parallel runways are too close together to allow for simultaneous operations on bad weather days. So that airport winds up taking extensive delays, and weather isn't blue sky every day. You have rain, as you did yesterday, and operations per hour decline. And then infrastructure issues. The government doesn't want to talk about this, but they did not train air traffic controllers for 18 months during the pandemic. And you've got a lot of controllers retiring. And I get very passionate about this because the airlines have a hard time talking about it because obviously they're dependent on the government for ATC. But the FAA should handle safety and security, and a private corporation should handle air traffic control, and you'd get more investment, and we'd be in the 21st century instead of in the
18th century with the Wright brothers in North Carolina. Helene, one final question. John from London emails in and says, what's your single best buy? What's your single best buy right now at Cowen?
Yeah, United, UAL, is our top pick for 2023. It outperformed in 2022, and we think because of their international exposure, it will outperform again in 2023.
Helene Becker, thank you so much. Terrific brief there on a day of earnings. She is with Cowen. Again, they own the high ground on this for a year. The other matter, which we really haven't talked about, we don't need to do it now, is Boeing Airbus, the Guy Johnson expertise in London. And I'm hearing more and more percolation about people are like, what's Boeing really doing in terms of innovation? They're so distracted by all these other tangible engineering challenges that they have.
Although also, how much can they just bank on the fact that all of these airlines, particularly internationally, are going to be increasing capacity because everybody's business class and lining up for the different, different places, the different clubs and the different airlines, the different lounges.
Mr.
Have you
Kurt,
been on part of that story about how crowded the lounges are and them trying to push
well, I was
back on that?
I've seen it. I've seen lines stretched out the door. It looks like it's the longest line frankly, it's the longest line I've ever seen in an airport.
So they've got,
miles.
but now they're trying to sort of delineate, getting the golds, the platinum members get first dibs, and everybody else, if you're, American Express, you wait in the other line.
I have had a senior aviation officer off the record tell me it's their single biggest headache. It is a disaster. All this premium thing. I was just taken from Iron down to Balsa Wood at one airline.
How'd that work
took me down. I'm not kidding, folks. They took me, there's platinum, gold, copper, the others.
Coal.
Coal, and then you get the steel, and below that's Balsa Wood. And they just took me down to Balsa Wood.
So what kind of perks do you get?
They give you, the Starbucks is over there. You'll love it.
Yeah, exactly.
That's what I get. Helene Becker, that's what we do here. We have conversations with people like the other day, Jessica Reif Ehrlich. Thank you so much at Bank of America for attendance, and the great Helene Becker there on what the sell side thinks of these different indices. She said they're United Airlines.
Yeah. With international presence as well.
Futures advance. Becker moves the market up 20. Stay with us. Good morning.
DPDHL is sending a consistent message with its investments. The company spent 123 million euros to upgrade its logistics centre at the Cologne Bonn airport, designing it around key strategic goals.
What I love about this building is it actually shows the big mega trends which formed our strategy 2025, which was inaugurated in 2019 when this building opened. So globalization, connecting the world. E-commerce, we have a lot of sortation facilities here for smaller e-commerce shipments. Sustainability, it's a very sustainable building with solar panels on the roof and everything. And digitalization, and well, you can obviously see that it is quite automated.
How did the team pitch this investment to you initially, and how hard was it as a sell for them? How quickly did you turn around and say, yes, this is worth 123 million euros?
Of course, you always have to make sure that you have the right capacity for the growth in the network. And at that time, they came and said, hey, we will really see a strong growth in e-commerce volumes on top of the regular B2B growth. We need more sorting capacity. We need this building. And of course, there are always debates. Does it really have to cost 123 million euros and so on? But fortunately, they convinced us, because then with COVID and the volume surge, we urgently needed the capacity.
As governments, we have a responsibility to create the incentives and the space for you to flourish, a receptive environment for change, and the accountability that comes with guardianship. In many nations, the foundation for this approach has been laid for us long ago if we choose to listen. Where I come from, Aotearoa, New Zealand, a beautiful place you must visit, our Indigenous people hold a worldview that every single living and non-living thing is connected. Our people, our plants, our animals, descendants of Ranganui, the Sky Father, and Papatuanuku, the Earth Mother, and their children. And so it follows that people and nature are kin, are family. And we must care for one another in the spirit of kaitiakitanga, which translates into guardianship by the people of the land for the next generation.
Lisa, you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
We're getting from all central banks, they have a lagged impact, and they're designed to create unemployment, designed to reduce demand.
Since late April of last year, it's all really been about the central banks.
Look at what's priced in for the Fed for the next two meetings. We've got less than 50 basis points priced into Fed funds now.
The ECB's not out of the woods. Madame Lagarde's got more work to do, and her colleagues have got more work to do.
The ECB is likely to hike more, but the question really is that in the price now or not?
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
We've gotten some earnings. Here comes the U.S. economic data dump. Good morning. This is Bloomberg Surveillance on Bloomberg Television and Bloomberg Radio. John Farrow over in London, Tom Keene in New York with myself, Lisa Abramowitz. And in 30 minutes' time, we get the latest read on the fourth quarter GDP, perhaps either confirming or not this belief, this optimism that we're seeing in markets.
No, much more than that. You mentioned earlier within your briefs this morning, Lisa, the PCE. We see that at 8:30 as well. I just look at the ECO screen because I'm too dumb at this, and I just count the lines. And I'm sorry, it's a 15-line Thursday. There's a lot of data.
There's a lot of data, and a lot of people are going to be looking at the GDP number. How much did you see the U.S. economy grow faster than people had expected? I'm looking also, though, at jobless claims. 1 week after another, they're coming in lower than expected, this resilience, and it sort of might kind of bleed into this belief that we're going to see a just complete rollover in inflation.
Well, that's what it is. It's a belief in the way the price is moving. And Deborah Cunningham, I thought was very good on that. It federated. I'm going to go to Liz Ann Saunders earlier, who made it clear she's watching housing. We get new home sales. I think that's near the end of the Pharaoh soiree in the 9 o'clock hour. Do you realize he's doing that? I think it's at 2 p.m. in London.
3 p.m., I believe it starts.
Whatever. I mean, it's like 3 p.m., 2 p.m. I can't keep track of the time. I mean, he's living large over there. But the bottom line is you can see a pandemic boom in 2020 on new home sales, one-family homes, and then it's a crater. And the now what is what Liz Ann's looking at in the real estate market.
The reason why it's been so difficult to get your arms around what's going on in the economy, as we've seen from the earnings, is such a bifurcated picture. You've got earnings that are really good in certain service sectors and not so good in the industrials. And where does tech play into that? And really, that's the story that we've seen, the rolling kind of recession, the rolling sense of a disinflationary push. And that's really what I'm going to be looking for in this data.
The inflation's still the story here. A little bit of economic scare the other day, although it didn't affect the market. Let me start the data here, Lisa. Jump on board. Futures advance. Great. It's really become a better market. There's no other way to put it. Futures up 23. The VIX solidly under 20, 19.21 after yesterday's festivities. Yield market not giving me much. A broad higher yield statement there. The real yield, 1.16%. And I'm sorry, the most important number on the screen for me, Bloomberg Financial Conditions Index, which is screaming accommodation.
Especially at a time when the market just wants to go up, and we see that time and time again. I just look at that S&P over 4,000 as we get earnings that are a motley picture, and yet people, they do.
We're still a motley crew.
We are. John, save us. John, I miss you. How are you doing over there in London? What are you doing over there? What'd you have for breakfast?
It's my job to save us pretty much every single day, just to be very clear.
The show starts at 2 p.m. local. 2 p.m. local.
2 p.m. local time.
Good morning once this week. So good morning at 1 p.m. London time. David Page joins us now, the head of macro research at AXA Investment Managers. David, great to catch up with you. Good afternoon to be precise. About 27 minutes away from data in America. You know the debate right now. It's cuts or no cuts. You're on no cuts. You're in camp no cuts. Tell me why for 23.
Well, we think the US economy looks like, we'll see in half an hour's time, that it closed the year a little bit firmer, and we think that that gives a little bit more momentum for the year. So we are looking for recession across the course of this year. But A, we think it's going to be mild, and B, I think, depending on the composition of the data later, it could start later. So you've got a Fed that's seeing the economy that's ending the year stronger. The labour market's still pretty resilient. I think the risks over the next couple of meetings, we think they peak at 5 in March, but I think the risk is that it could be a little bit more than that, and that just pushes the timetable back. So I think, the broad story is the Fed will deliver a slowdown in the economy. It will deliver a loosening in the labour market, but it's how quickly it can do that and whether or not it wants to ease back this year, and we think it probably happens in 24 rather than end 23.
Not all rate cuts are created equally. I think that's my frustration with the debate right now. It's the framing of it, and I was just guilty of it then. No cuts or cuts. Let's talk about if there are cuts. You can get cuts for one or two reasons. For this Federal Reserve anyway, you can get cuts because we get a soft landing that no longer requires high interest rates, or you can get cuts because we get a hard landing that requires much looser policy. Which one is it, and why are we not framing the debate that way?
Well, I think it's going to be a recession, but a mild recession. So it's a hard landing, but it's not as bad as it was in the pandemic. It's not as bad as the GFC. We're not looking at the Fed that cuts rates back to 0 on the back of this. And at the same time, you've got an inflation story that we think is going to be a little bit stubborn over the second half of the year. We think it's pretty easy to get headline inflation back to sort of 3.5%, 4% by mid-year. It then sort of starts to level off a little bit. And that's when you start seeing the Fed thinking about, well, if the labour market's tight, service sector inflation is going to remain relatively high. What do we need to do to keep it or to drag it down into 2024? And it's unlikely at that point that they're going to want to be tightening policy any further. So I think it just adds to the view that they hold the position that they've got for a little bit longer, and that adds to the view that we see contraction in the economy.
Investors don't buy this second phase of this effort. Neil Kashkari, the Minneapolis Fed president, wrote about this in a blog in early January. He talked about the second phase. The first phase is you get from 0 to 4 really fast. They've done that. The second phase is you get to about 5. He thinks 5.40, and then you wait. What is it about the then you wait that people just don't get?
Well, I think part of it is, of course, what markets are actually doing. So markets are pricing a mean outcome. They're not talking about a central case. My central case is we see a recession. We don't see cuts until 2024. The risk is you see something deeper, and the Fed has to act a little bit more aggressive. And the market puts a probability weight on both of those and then gives you something that is obviously skewed to something that's coming off. So I'm not so sure that when we've got 50 basis points or so priced into the market, that is a central forecast of all of the market looking for 2 cuts this year. I think it obviously sort of spreads a range of views.
It's a very good point. I want to talk about the potential also that this recession gets pushed out even further. Binky Chadha of Deutsche Bank was on the show with us yesterday. Binky published in the last 24 hours and questions whether we should be pushing out this recession call and endorsing the idea that this rally in the equity market we've seen so far year to date, early days, can continue. This is what he had to say about why. He said real household income, after falling for a year, has grown solidly for the last 5 months, supporting real private consumption, which has continued to grow within its pre-pandemic up channel. What do you say back to that?
I think what's supported, and it does look like consumption was pretty solid in the fourth quarter. Again, we get the data in a bit. But it's not necessarily been strong income growth. It's been the fact that households have been happy to use their excess savings much more quickly than we thought, much more aggressively than we thought. So they're drawing down their saving profile much more quickly. The question is, does that mean that overall there's more excess savings out there? Have we just underestimated that? Well, and that's plausible, and therefore you would see a stronger backdrop. Or are households just getting through their savings more quickly? So we think that it's savings that have supported consumption in the fourth quarter. The question is how long that can last. We think that what's happening is that they're being used more quickly, and therefore at some point as we move into the back end of this year, you'll start to run out of that saving, and the saving rate will have to rise a little bit more quickly. And that, I think, adds to some of the downturn that's coming through. But the uncertainty of timing of recessions is renowned. It's very difficult to predict. We have probability models that suggest we'll have a recession now, but over the course of the next 12 months. So that's why the composition of the GDP number that comes out later is very important to give you the precise time.
I want to talk about the significance of 190,000 as well. It seems to me that the most bearish people on this economy right now have to sit there and look at 190,000, and it forces them to question their view on the economy. How do you look at that number? We get another release of claims in a bit. How do you look at 190K?
I think we see it in the context of also a payrolls number, and also the employment, the component of the household survey's employment number, which has also been resilient. The labour market is more solid at the moment. Now, with claims, we always get a little bit flighty, particularly over seasonals, and seasonals are a question given the big issues that we've had over the pandemic over the last couple of years. So we are wary of putting too much weight on just those on that jobless claims itself. But taking in the round, all of the labour market is really tight at the moment. That's why we're thinking of pushing out the timing of our recession back to later this year rather than starting at the start of this year, which is what we'd previously thought. To some extent, that reflects the dynamic that we've seen in growth, but it's also obviously a driver going further forward.
The stubborn bear would turn around and say, wait, which is essentially what you're saying. Wait, it's going to change. The labour market data is going to change. You don't think it's going to change that much? We're at 3.5% unemployment right now. You think we could get a recession and only get to what, 4.5?
Yeah, so we're forecasting 4.5 by the end of the year, which is unusual. I mean, the average recession, if there is such a thing, sees a sort of about a 2 percentage point increase in unemployment. Obviously, deeper ones, the GFC saw a much bigger shift coming through than that. But we do think there's some validity to the Fed's view that on this part of the beverage curve, what we might see is a reduction of the pent-up demand. We might see vacancies fall without the need to see job cuts come through, and that the combination of those factors can see wage inflation come down. Now, depending on what happens and what number you take, the last payrolls report suggested that actually average earnings is not far from the golden zone that the Fed would be aiming at, say around 3.5%. But of course, in November, it was 5.8% annualized. So we're, again, not putting too much weight on that. So I think, Powell will talk about in the round all the different indicators they look at. The labour market is key for the Fed.
The Federal Reserve next week. David Page of AXA Investment Managers. David, this was great. Thank you. TK, that's the debate going into the data about 20 minutes away and into the Federal Reserve decision next week.
And also the ECB division, John, in the last 24 hours, as long as it's taking you to celebrate Australia Day. I mean, I know you went over to Wander in London there and had some Vegemite butter, the whipped Vegemite butter, to celebrate Australia Day. But, John, something seriously has happened in 30 hours. The Bloomberg Financial Conditions Index for Europe and the United States has sharply diverged. Accommodation in the United States and almost a new restrictive tendency, John, that Lagarde has to face at the ECB.
Tom, we talked about this in the past 24 hours. You've just got to compare the incoming data to expectations, the surprise indexes, and it's been pretty clear over the last few weeks that the data out of Europe is coming in surprising to the upside, and the data out of the United States has started to surprise to the downside. That's negative. There is a belief that this ECB this year is going to go a whole lot further than the Fed can go. It's a catch-up year for Europe, Tom. We'll talk about the extent they can catch up over the next 12 months.
Yeah, I hope you get better weather, John, up Manchester City against Arsenal. I know it's not today, but I just hope the clouds, the London glue.
It's freezing, Tom.
Clears
it's
away.
Freezing.
Well, you could freeze at Manchester City watching the dreaded Gunners from Arsenal. We'll see. John Farrow in London. He continues with his good discussions there as well. Futures advance up 18. Dow futures up 58. John, the 9 o'clock hour. Look for that. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Russia has launched a major barrage of cruise missiles attacks against Ukraine. Authorities there say the attacks were aimed at energy infrastructure and other civilian targets in Kyiv and other cities. The assault happened a day after the U.S. and Germany promised to supply Ukraine with tanks. That gives the Ukrainian forces a significant upgrade. Bloomberg has learned that the mayhem at the New York Stock Exchange earlier this week has been traced to an employee who left a backup system running. That mistake triggered wild market swings involving more than 250 companies. Thousands of trades were canceled at a cost yet to be determined. U.S. health officials would like to get the frequency of COVID shots down to just one a year. Today, they'll start discussing how to do that. Food and Drug Administration advisors will talk about which strains of coronavirus would be in an annual vaccine and how they would be chosen. American Airlines is out with an earnings forecast for 2023 that beat estimates. The carrier also posted fourth quarter profit that was better than expected. American says it's still on track to pay off $15 billion in debt by the end of 2025. And a change at the top of Toyota. The Japanese automaker is promoting Lexus president Koji Sato to replace Akio Toyoda as CEO. Now, Sato's job will be to guide the company through challenges of electrification and automation. Toyota, who's the grandson of the company's founder, will become chairman. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, China Open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power.
This is Bloomberg. The top names in global leadership are on Bloomberg.
I very much support the idea of a stronger sovereign geopolitical European Union. Democracies should cooperate and that they should understand that there is something we have in common: respect for the individual rights of men, being in favor of the rule of law.
Nobody covers the top global leaders like Bloomberg Television and Radio, your global business authority.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Earnings season is here.
Big banks, that was the big story.
From the big banks to big tech.
Everybody is losing a lot of money.
It's a question of how high the bar is set.
Bloomberg breaks the numbers first.
A blockbuster number. Blowing through estimates.
These guys are minting money.
With exclusive expert analysis.
Does this approach make sense to you?
We're going to have to make an acquisition.
Does this quickly become just a really crappy business model?
I don't think their business is as broken as the world thinks.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
We have basically, as you know, a call for a recession in the U.S. Starting in Q3. So second quarter, keeping in line with the recession playbook historically. We have the market going sideways, so that's still 4,500. We have, if the recession happens in Q3, a pretty severe sell-off, which would take us all the way down to 3,250.
I caught our camera staff taking notes for Bikram Chadha. He's Chief Global Strategist at Deutsche Bank. He is the optimist out there. He's moved the timeline up, but Binky has not given way to the gloom that's out there. Futures up 17, Dow futures up 49 right now. No gloom in the last 3 or 4 days. It's a market with a bid, Lisa.
I was going to say, basically, people have pulled back from that gloom, and they're basically saying everything's great now. Go head in.
Yeah, we're going to have to see on that. We're going to pause right now and talk Japan. I've had the immense privilege of attending Japan for Bloomberg any number of times. It's always something unique and separate in the world, and spanning across 3 generations is a company that started literally in fabric, and 3 generations back said, maybe we ought to make cars. They ran into the immense challenges of World War II, and they picked their pieces up. His father invented modern Toyota. There's no question about it. And Akio Toyoda today announcing his move from president to chairman. I can only say he is extraordinary in the malaise of Toyota that he took over and the moonshot of performance he's done versus other auto companies. We spend way too much time on the dalliance of autos where this guy literally, Lisa, on a worldwide basis said, we can do this. And the lessons learned from Toyota for all in automobile engineering have been humbling.
It's something that we're going to be talking a lot about, people who are sort of the old guard, the legacy, transitioning to a new model in a new era, and Toyota very much in the forefront of that during this transition to electric, to trying to deal with the Japanese economy versus the rest of the world. I will say, it has been interesting with earnings that people are optimistic, but they're not that optimistic. Which is
exactly. We don't talk between the set. Lisa and I can't stand each other. I was thinking exactly the same thing.
So maybe we should
3 or
talk
4
more.
minutes ago.
Okay.
It's like a tweak quarter.
Yeah.
BMO Capital came out on IBM and they tweaked like $4 or $6. We're tweaking.
But tweaking is a good thing if you do investment grade credit. I mean, this is the interesting thing.
Stop talking
but
to
this
me.
is okay. We'll have a great time with that. But this is the reason why investment grade credit has been in the sweet spot, as Phil Camporelli of JP Morgan was talking about, because they're not optimistic enough to go into U.S. Equities, but they do want to get that income. And Matt Brill has suddenly found himself from the pariah to the golden child overnight. Matt Brill, head of U.S. investment grade for North America and senior portfolio manager at Invesco. Has it gone too far?
Hey, good morning. Last year was just really, really tough, and we were far from the golden child last year, and it was a challenge. But then it got to the fourth quarter, and things started to look extremely attractive. You got to about 6% yield on investment-grade credit. Nobody really wanted to buy it then, though. They were still very nervous. They said, we'll wait till we'll enter when the Fed stops hiking. And all of a sudden, we've ripped about 100 basis points. Returns are up about 10% since the end of October. So it's come a long way, but we do look at things now, and we still say they're still around 5% for IG credit, which looks attractive to us over the long term. And we think their yields are going to still go lower over the year, and you're going to get that carry.
Over the long term. Is over the long term the past 10 years, or is over the long term the past 50 years?
Yeah, so definitely over the last 10 years. But then we look back into kind of the 2006 range, 2005 range, and pre-distortion by the Fed. And pre-distortion by the Fed, you did not tend to get yields much higher than 5%. So we think that that's normal, attractive over the long run. And over the near term, looks very attractive, though.
Microsoft, 4.3% in debt. Are you going to see the mother of all issuance here? Every CFO is going, I missed the bottom. Do they, like lemmings off a cliff, dive in now?
So it's interesting. We're actually seeing the opposite, is that a lot of companies are saying it's expensive to borrow right now. And what we're finding is that most companies are actually finding that if they want to borrow for 3 or 5 years, it costs them 5%. If they want to borrow for 30 years, it's also still around 5%. And to them, they think 30 years at 5% is expensive. So we're seeing companies only issue 3 and 5 year bonds, maybe a little bit of 10-year bonds. The issuance of 20 years or longer is only about 5% year to date. So companies actually are still finding this expensive. I do think with the tech companies where they've had some troubles, they've been laying off workers, they might want to borrow, but they don't want to borrow at these levels. They actually still find them pretty punitive. Versus where they're borrowing just a few years ago.
I mean, the reality here, folks, is they dial 1-800-MATT-BRILL. I mean, that's the truth. That's a story. They call, your good competitors and all that. Is your phone ringing off the hook? I mean, are people trying to sell you, medium duration stuff?
So they're trying. It's really fascinating. Is that they're not issuing a lot of paper right now. The banks are not issuing almost any. Banks have really only Morgan Stanley has issued really any significant amount of debt this year. The other banks haven't issued at all. I think Bank of America made it a 3-year. Typical corporations on the industrial side of things are borrowing, but at a much lesser amount. So it's very different than 2020, where everybody was borrowing because they were borrowing for 1-2% for 30, 40 years.
Well, but this is the reason why you saw this migration within the index to a lower quality, to a more leveraged kind of company. Are we going to see the reverse of that as companies do see rates as punitive, as a lot of companies look to pay down what they have rather than borrow more?
Yes, and that's great for us versus we hate when companies go borrow to buy back stock. We hate when companies lever up their balance sheet to go buy competitors. Right now, they're saying it doesn't make a lot of sense to go borrow at 4.5%, 5% to buy back our stock, even as much as their stocks are down. So for the most part, people are paying down debt, and companies' balance sheets are getting better, which we need because the economy is going to start to slow. And if they're not out in front of that, they're going to have some problems.
Can I just say, folks, that what you're hearing here with a grizzled pro is what we call real bond talk. Real bond. It's not like, what's the Fed going to do? What's inflation going to do? It's not economics. It's like real bond talk right now. When do we get back to a confidence in longer duration paper that we can own it? I mean, I'll go 7 years, forget about 20, but when do we get back to Boise Cascade putting out a 9-year piece or a 10-year piece?
So the confidence, unfortunately, comes back when the returns are already there. That's what we tend to find.
Top of the market's what we call that.
Yeah, and we've started to see flows pick up, but people are still just barely dipping their toes into the water. I'm a little nervous that rates could run too much before people get involved. I think there's a lot of investors that are in T-bills that's just been sitting there and rolling T-bills.
Yeah, the cash charts are stunning.
Yeah, I mean,
we're making
staying.
jokes
Yeah,
about
exactly.
it, but it's stunning. Am I right?
Yeah.
And we're begging them. You know, we think refinance risk is a real, and reinvestment risk is a real thing for investors this year. Reinvestment risk, meaning...
What does that mean?
It means that if you borrow for 6 months, that's great, but what do you do when 6 months when that bond matures?
Does that mean that you think the Fed's going to be cutting rates by the end of this year to not real bond talk?
We don't think they're going to cut by the end of this year. We do think early 2024, it's on, and that's when you could see 100 basis points in the first quarter of 2024.
His entourage, I mean, did you see the entourage Matt Brill brings with him? They're like taping it, they're in code, they're sending smoke signals back to Atlanta right now. What you're saying or that is, it's fun though, right? I mean, after the carnage. I mean, seriously, last year was worse since 1788 or whatever. Are you having fun this year finally?
We're having fun. We've got a very cool crew with sunglasses on. They're all walking around, you know, feeling the love this year. But last year was
work from home.
Last year was very,
it.
very tough. I want to be honest. You know, we have not made up nearly even a third of the gains or
when
a third
do
of the
you
losses
make up the carnage of last year?
So I do think
5 years.
I think it's a 2-year time frame. I think this year you could still see double-digit returns. We're up 4 already. I think you could get carry and a little bit of tightening, get you 10% That's a pretty good year.
Tweaking, it's the way to go, I guess. That's for
it's what it is. That's the happiest I've ever seen.
That's a great bond portfolio manager. Well, I mean, this is sort of the sweet spot for them. If you've got slowing growth, companies deleveraging, and rates potentially plateauing or coming down.
That's the happiest I've seen Matt Brill in 2.5 years. I mean, it's good. I mean, this is the changes, folks. We're trying to give you these seismic changes here. And in the yield market, to me, there's never a discussion about the issuance flows, which, you know, that's what you did. I mean,
well, yeah, issuance has been down. All of the technicals supporting some of the rally as well. If companies aren't selling debt, aren't really increasing their leverage.
Matt Brill moving the equity markets higher. Futures up 17. Stay with us. This is Bloomberg.
Solar energy, wind power, battery-operated cars. The transition from old to new energy forms has investors placing bets on which technologies will come out on top. Bruce Flatt's Brookfield Asset Management sees what it calls massive opportunities. Its new impact fund raised more than $15 billion, and Flatt says it could have raised more. The fund has two targets: companies that need to dramatically curb greenhouse gas emissions, like power providers, and those that are in a position to dominate in clean energy. Brookfield hired former Bank of England Governor Mark Carney to strengthen its environmental, social, and governance investing. In March, Australian utility AGL Energy shot down Brookfield's takeover offer. The firm had aimed to accelerate AGL's transition to net zero emissions by over a decade. Carney signaled that this was no problem. He says Brookfield is reviewing at least 50 potential transactions across a range of industries.
Bloomberg surveillance from New York. Jonathan Farrow at 9 o'clock. Look for that in London as well. Lisa Bramlett and Tom Keene. And we're getting ready for economic data. I thought it was yesterday. Lisa corrected me, as she does. Thursday with claims, but with a lot of other data. And there's no one better to lead our coverage of this than Michael McKee. And part of that, not just Thursday in claims, but Thursday in a look back to the 90 days, the Q4 of 2022. Michael McKee, we don't see GDP yet, do we?
We don't see GDP yet, but we are looking for it very shortly here. It should come out at any time. There we go. Better than expected, 2.9%. That's down from 3.2% in the third quarter, but that is still a very good number. So we're not going to complain about that at all. Calling up the current release, I'll get you the breakdown on that in just a second. But let's go through all of the other numbers we have to do, which is a lot. The trade deficit actually widens in the month of December, $90.3 billion from $82.9 billion. That's a bit of a surprise, and I'm sure it will have some effect on the overall GDP numbers. Speaking of GDP, the price index, the PCE index on a quarterly basis drops to 3.5% from 4.4%. The core 3.9 from 4.7. Those are better than the prior quarter, but not as good as was forecast. So make of that what you will. We get the rest of the GDP, the December numbers, which will really matter to the Fed tomorrow. Wholesale inventories rise 0.1%. Retail inventories 0.5%. Those will feed into those GDP numbers. Jobless claims. Hold on to your hat, Tom.
I'm holding.
And you have a good-looking hat. 186,000 last week. This is not the droids we're looking for. Well, that's down from a revised 192.
You look at the numbers for 2 seconds, folks. I'm going to sell this to you. We've got a very busy half hour. We're coming to you across all of radio and television without commercial interruption. This 30 minutes or so important. Shanali Bassick will be with Jonathan Gray, but far more. After that, McKee and I will grill on the stunning jobless claims numbers. And Michael, it goes back to 4-week moving average, and that dovetail claims right now into a 2.9% GDP statistic. I'm worried. It's terrible. It's a terrible
I need to get to the breakdown of GDP, but I think at this point it just tells you that the economy in the fourth quarter and it was reasonably strong, and the economy, the labor market economy, is still strong right now. But there are reasons for that. Stay tuned, as Tom says. A couple more numbers here that we got to get to. 5.6% is the durable goods orders increase in the month of December. That's up from a negative 1.7. So that's really really good. But ex-transportation down 0.1. Now, we know Boeing had poor quarter, so that probably has the major impact. Capital goods orders, non-defense ex-air, this is what goes into GDP directly, down 0.2 after a 1/10 gain the month before. Shipments were down 0.4, so that's going to have an impact on GDP as well.
Lisa, with the markets here, yields are higher. We're going to go
That's
into
the
it.
story.
Futures up 13. Lisa, to me, I mean, is tuition a capital goods?
Well, it's perhaps a service. I don't know.
Okay,
But I'm looking right now at that 2-year yield. I really want to hone in on that because it's 4.18% and climbing higher from earlier 4.12%. And honestly, Mike, when you take a look at this data, do you buy the story that people say this is backward looking and that what we've gotten in terms of leading economic indicators shows a much more rapid shift that supports the soft landing that people talk about now?
Well, some of the data seem to be pointing in that direction. A lot of people are ragging on the index of leading indicators, but some of the numbers that we're getting are better than expected, and so there's a feeling that maybe things aren't as bad. Certainly GDP is a backward-looking number, but it does give us some idea of where we are and where we are going. Taking a look at some of the GDP numbers here, we can say that GDP for the year of 2022 grew 2.1%. The forecasts are we're going to have a bad year this year, but 2.1% certainly better than people thought. Personal consumption was up 2.1% in the fourth quarter, and that compares with an anticipated 2.9%. So that comes in a little lighter, down from 2.3%. Goods spending was up 1.1% after declining 0.4 in the third quarter, whereas services were up by 2.6%. That's down from 3.7%. So the mix a little different than maybe people anticipated. Investment by businesses, business spending, non-residential fixed investment up 0.7. Residential investment. This is where the Fed has had an effect. Anybody want to guess? Negative 26.1% after a negative 27%.
All of that, all of that was in 6 blocks of Lisa's house.
Things are going down.
Have you ever seen that number? Have you ever seen a number that?
We saw it in the 2000, the wake of the great financial crisis in 2008. Let me just check.
One more number.
Yeah, give you one more number. And this is one that people really want to pay attention to because it kind of strips out the effect of inventories and trade. Final demand for domestic product up 1.4%. It was 4.5% in the third quarter, but 1.3% in the second. So in general, it's held up, but it's not extraordinarily strong.
This is a big number in the Q4 adjusted by things away from domestic final sales. Michael McKee will have an important comment for us here in about 15 minutes. We're going to continue now, and on This American Economy, Lindsay Piegza joins us, chief economist at Stifel. Lindsay, are we near recession?
I think we are teetering towards a recession. Now, of course, the fourth quarter number does look pretty good, particularly against the backdrop of an even stronger rise in the third quarter. But when we look at what's happening with the consumer, which is the backbone of the U.S. economy, we are seeing a clear loss of momentum. And without the consumer happy and healthy out in the marketplace, we simply cannot expect to maintain positive growth, let alone more robust growth, similar to what we saw this morning. So I do think that as the Fed continues to raise rates, savings are depleted, real income remains negative, fiscal support fades, there is going to be an additional burden on the consumer that leads us into or near negative growth.
Lindsay, long ago and far away, under the religion and the Kool-Aid of Peter Lynch of fidelity, domestic final sales reigned supreme. Michael McKee just mentioned that trend, that tendency there away from the back and forth of imports, exports, and the rest is a pretty moldy number. Do you have a belief here that a slowdown in domestic final sales brings on the reality of recession?
It certainly does, because just like when we look at inflation, we strip out the more volatile components of food and energy. That's what we're doing when we look at that real final sales number to domestic purchasers. We're stripping out the volatility of inventory. We're stripping out the volatility of trade. And what we see is a more clear, defined downward trajectory of growth, slowing from up near 4% to down near 1% at the end of the year. Again, still, there was enough resilience in the U.S. economy to maintain positive momentum in Q4. But the bigger question is, are we able to maintain that momentum as we turn the calendar page? And most of the data suggests that we do not.
Lindsay, do you think that the market is wrong because we are seeing consumer stocks do really well as they look forward?
I think the market is severely underappreciating the amount of tightening that the Fed is going to have to embark on in order to reinstate price stability, and thus underappreciating the amount of pressure that is going to be put on consumers and businesses and the overall economy.
When do you start to see the data to actually prove that before thinking, well, maybe the Fed is going to be on the side, you do see inflation coming down, and we're going to get that soft landing that everybody's talking about?
I think we're already seeing it in the data. When we look at retail sales, negative in November, negative in December, consumer spending still positive, but when we look at overall goods and services, that too is trending down. Production now in contractionary territory, housing taking a sizable hit. There are multiple data points that are suggesting the U.S. economy is not going to be able to maintain this momentum in the new year.
And Lindsay, thank you so much. Lindsay Piegza with Stifel, great that she's with us today. And Michael McKee mentioning that housing hit, which is a negative 25-ish% statistic, something that shows a unique concern. Liz Ann Saunders mentioning housing is critical to her in the previous hours. You know, it's original right now is how I would put it.
And the view ahead is what we've been trying to glean from all of the earnings, both from the on-the-ground companies, the manufacturers, as well as some of the asset managers. And Chanel Bostic has been covering all of it for us here. And I'm curious, especially with Blackstone and their reported earnings, what we're going to hear from John Gray, the Chief Operating Officer, as he joins us now.
Yeah, absolutely. So we are going to hear from John Gray just shortly here. We're going to be joined by President and CEO of Blackstone, just shy of $1 trillion in assets under management. John, thank you so much for joining us this morning. When you take a look at your results as you've reported them for the year, you had a tougher quarter than you've had in a while. A lot of that underperformance was in real estate. So my question to you is, when does the pain end?
Well, Shanali, it's great to be here. The fourth quarter was a tough backdrop in markets. We also had some timing issues that make comparisons hard. But when you look for the year, we really delivered for our shareholders. We had earnings growth, distributable earnings growth of 8%. We grew our AUM 11%. And most importantly, although in the fourth quarter we had some modest declines, we delivered in terms of performance. We protected the capital of our limited partners, generated positive performance in real estate in particular. And that was a reflection of where we deployed capital. And so I think when you allocate capital to the right places, you can overcome a challenging environment. If you focus on travel and travel-related assets, energy, floating rate credit, logistics and rental housing and real estate, quant and macro and hedge funds, that really made a difference. But I think in terms of your question on when we get these headwinds behind us, I think the good news is the inflation pressures seem to be abating and the 10-year Treasury moving down. And the biggest headwind has been on multiples. The good sectors we're in have performed well. The pressure's been on multiples. Some of that pressure seems to be going away now.
So we're well over last year. We're well into this year. So how are you positioning Blackstone to capitalize on the market of today?
Well, the great thing about our business is because investors have so much confidence in us. They've allocated $226 billion to us last year. You mentioned nearly $1 trillion of assets. We have $187 billion of dry powder. And so what we're looking for now are the most compelling opportunities. I would say private credit, very interesting. Base rates are up, spreads are wider. You get paid equity-like returns for being a lender in corporate credit and real estate credit. I think there are also some companies out there that may not be defaulting, and default rates remain very low, but may need some capital. So our tactical opportunities business can help them with some structured preferred equity to help them get through maybe a tough patch. And then I think the public markets in some of the sectors where there have been big trade-offs, in technology, in real estate, there'll be opportunities to buy some good businesses that are trading at what we think of as attractive prices.
John, let's talk about the opportunity of the past and whether it continues to be going forward. I know that, for example, single-family homes was a big point of play for Blackstone. Is it still?
You know, I think the single-family space was very favorable coming out of the financial crisis because new construction fell, home prices were at big discounts. We continue to like housing generally because there's a shortage. We've been underbuilding housing about half below what we need relative to sort of obsolescence and population growth, really since the financial crisis. Now, I think you have to draw a distinction between for-sale housing driven by mortgage rates and homes that are rented out where there is still upward pressure on rental rates, albeit slower than last year. So I think it's still a good long-term area. Obviously, the housing market faces some challenges, but rental housing is much, much stronger than for-sale housing.
Perhaps for a hold situation, but I am wondering, especially given the auctions that people talked about that used to be just bought up by institutional investors without it really even getting an open house, are those days over?
Well, the market is definitely cooler. Cost of financing has gone up, and that has resulted in, an adjustment happening with prices. That's happening across private markets. And so I do think it will not be as heated as you described going forward. But as an asset class, I think selectively single family for rent is interesting, but it's worth noting it's a tiny piece of the overall U.S. housing stock. I think it represents less than 1%. It's not really a key driver, but some of these large companies I think can operate and deliver customers an opportunity to live in a community at a reasonable cost, and I think that's a win-win.
I want to kind of jump to the whale in the room here. That's BREIT, and this is this interval fund that you have tied to the real estate sector that has certain pressures in it, whether it's on the investor side or whether it's the broader market. And I'm wondering, you have this extra $500 million that University of California had just given you. How much of this is to meet new redemption requests, and when do the redemptions stop?
So BREIT is a vehicle that we're incredibly proud of. We started it 6 years ago to give individual investors access to private real estate. It's delivered 12.5% annual returns over that period, more than 3 times the public REIT market. It's happened because we focused in the right sectors, in rental housing, in logistics, huge concentration in the Sun Belt, places like Texas and Florida. And we've delivered for customers. As you pointed out, there have been some elevated redemptions. It happened over the summer. And then there's been what I describe as a challenging media cycle, sort of relentlessly negative news, focused on redemptions. And we got this large investment, now $4.5 billion from Cal Regents, that really affirms the quality of the portfolio and its outlook. And they have a structure with us that gives them some protection on the downside, but they made this investment because they believe in BREIT, they believe in the quality of the properties. And I would say one other thing, Shonali, what we found fascinating is that the focus is all about flows. It reminds me a little bit of a sporting event where people are focused on how many fans are in the stands. They're not looking at what's happening on the playing field. Yesterday, we announced that estimated same-store cash flow growth was 13% in BREIT. That's really powerful. The press isn't focused on that. That's what we're focused on, because if we deliver for the underlying customers, the flows will take care of themselves over time.
I want to kind of put Blackstone in context here in the broader financial industry, because there's been this huge move to private markets. But private markets, your stock took a nearly 43% hit last year. It's back up this year. But how do you play against your peers here when you look at the investments you're going to make this year? Are you slowing hiring? Do you have to pull back in a meaningful way given the choppiness of what the environment looks like?
Well, the underlying trends in our business remain incredibly strong. I mean, the fact that we grew AUM 11% in this difficult environment, we're seeing growth with our drawdown funds. We have a $150 billion target. We're going to say on our earnings call today that we've raised $100 billion of that for our drawdown funds and still reaffirm that target. We've got very fast growth in our insurance segment. Our institutional perpetual vehicles like infrastructure continue to grow. And in the individual investor area, private wealth, which you focused a lot on, we were up significantly. We were up 25% in assets for the year. And so as a result of that, to your question, we will hire more people, but at a much slower rate than we did in 2022.
Is this really the beginning of the end of the peak, this sort of heyday of private equity, of delivering 15% returns? Are we entering a new, slower grind that is perhaps a little bit more back to reality?
You know, we've been hearing this now for nearly 40 years since we started investing in private markets. And every time there's a downturn, there's a sense that, you know, the era is over, that private markets can't deliver. And yet we've had a durable premium across the board in our funds. And that's the reason why we've continued to grow. And we feel like in downturns, that tends to expand. So our confidence in our ability to deploy capital, also add value to the assets with our teams is as high as ever. Obviously, if the market's tougher, that makes it harder, but I think the premium return we can deliver to customers, that continues to exist. That's really the fundamental value proposition for us.
You know, John, on one hand, I know you have to prepare for all scenarios here, but if you have to kind of calculate your worst case scenario, what are you really preparing for as far as how bad things could get this year?
Well, I think the good news is the really bad and big challenging risk was a wage price spiral in inflation. And it appears based on what market data is saying and what we're seeing in our portfolio companies, that's not happening. Commodity costs, shipping costs, they're coming down. The labor market we're seeing in our portfolio is starting to cool. We actually have a third less job vacancies at our company. Wages, which had been running at 7% in North America last year, are now down and up 5.8%. So inflation coming down takes off the biggest risk. I think the main risk that exists is the economy decelerating as a result of this Fed policy. I think they're going to take rates up into the low 5s, hold it there for a while, and that medicine takes time to work through the system. And so I think a sort of cumulative deceleration is probably the biggest risk. But I would say when I compare this to 08, 09, when we had excess in housing, excess in commercial real estate, excess in the financial industry, we just don't have that. So our estimation is things are definitely going to slow, but I don't think it's going to be one of those worst case scenarios.
John Gray of Blackstone, thank you. Shnelly Bossack, always wonderful. Thank you so much for being with us. And we heard it right there. I mean, honestly, this is really the question. Does the Fed get to the low 5s in terms of a terminal Fed funds rate like John Gray is talking about, given the data that shows resilience, not this tapering off that a lot of people are talking about?
Mr. Gray talked in his book there, but I would point out there's a lot of other people not in financial instruments feeling the same way. And it's really picked up.
And that's the reason why. At what point does the reality kind of push back against that?
Futures up 22, they advanced. Dow futures up smartly. NASDAQ really on a roll. Let me give you, Farrell would say, John's in my ear. I can hear him here in London. He's saying, give the percentage move. Up a stick on the NASDAQ right now with yield set higher. We're going to pause. This is a real luxury with 6.5 minutes here to talk to Michael McKee about all the work he does, the papers he piles through, the detail he does that I don't, about a fully employed America. He and I know, if you look at the claims statistics, McKee 101 is, it's a fully employed America, but it's not, is it?
Well, it's kind of weird because all we've had lately are all these announcements, particularly from tech companies and financials, that they're cutting jobs, thousands and thousands of jobs, and yet jobless claims are only at, as we saw today, 186,000. How can that be? Well, there are a couple reasons, and this time I'm not even going to cite seasonal adjustment problems. The first and biggest reason is they may not have taken place already. Companies are required to give employees 60 days warning with what's called a warn notice of impending mass layoffs. Now, Google, for example, announced 12,000 layoffs this month, but its warn notice to those in New York said the layoffs would not begin until April.
It's called a warn notice.
So it's called a warn
Is that
notice.
the envelope I've got home in the kitchen?
Yes, but the good news is Chipotle's hiring. So
Oh, good. I feel better
you're
already.
safe. But we're not going to see a rise in jobless claims if people aren't getting laid off yet. That could come later in the year, and that could push unemployment up later in the year. Now, not every cut means that people are losing a job, because companies may not fill currently open jobs or those of employees who've already made plans to leave. Not all the job cuts are in the United States. 3M this week, 2,500 job cuts, but they said that was globally. And with labor markets tight, of course, some laid off workers may find new jobs quickly, and they're not even getting the jobless claims because they've got some severance that they're going to live on in between. Now, no question, with interest rates rising, as John Gray was talking about, we should see more people lose their jobs. We should. Economists surveyed by Bloomberg forecast that unemployment will rise to 4.8% by the end of the year. That would be, guys, more than 1.8 million jobs.
I'm going to ask kind of a sacrilegious question. Is this data reliable? Is this data perhaps a bit distorted from some of the leading indicators that we're getting?
Well, you could use that as a fifth reason. There are some concerns about the way states are processing claims during the pandemic, and some of their systems are really old and antiquated. We saw a lot of fraud before that pushed up claims numbers. So it's hard to say this is totally accurate, but it's the best we've got at this point. And even if you're just looking at the trend right. is rather amazing.
I just looked at one of John Gray's apartments. I'm thinking of sliding into 2,500 square feet, 3 bedrooms, 3 baths, 2,300 a month, 3,200 a month. It's something completely outside the frame of reference of anybody sitting at this table. The unemployment rate in Kansas, area code 66219, is 2.2%. Are we fully employed?
At this point, we appear to be pretty much fully employed. Actually, by the Fed's definition, which is somewhere around 4% or a little above, we're more than fully employed. So, I mean, we are below the NAIRU number, as they like. So, at this point, the Fed is looking at the fact that we are fully employed, that all these people have jobs, and they're looking at the spending possibilities, which we saw in GDP, and saying maybe we still got to do more.
Can I suggest that the last time the NAIRU number had validity, I was wearing a NAIRU suit? Is that like close? Are we close there?
The problem with NAIRU, which is the non-accelerating inflation rate of unemployment, is what level of unemployment makes inflation go up. The problem with that is it's a number you can't observe in real time. You can only sort of look at it
like my checking account.
Looking back.
Lisa saved me here.
Well, I was just going to give
you McKee's on fire.
The rent report, because we were talking about rents and this component of the inflation, and U.S. apartments rents rose 4.7% in December, which is the slowest pace going back to July 2021.
It's a huge deal.
And this is a huge deal. Rent.com, this research provider, expects that rents may be declining on a year-over-year basis by the summer.
Bring up this banner here. I think this is so important. On radio, 3 bedrooms, 3 baths, $3,220 a month for a house. Kansas 66219. Where we live, Lisa, is completely artificial.
Well, but it's catching up, and that's the interesting thing. If you look at the price increases, they've happened much faster in the Kansases of the world than they have the New York Cities of the world. So at what point do you start to see the real softening there at a disproportionate pace? I mean, it's really been a motley picture.
Well, a question for Jay Powell at this news conference is going to be, are you seriously looking through the rental numbers? Because it takes a long time to get into the price indexes. You look at core PCE for the quarter, 3.9%. That should be a reason to celebrate. It should be lower if you're looking through it and looking at the numbers Lisa was.
The market celebrates. We go to John Farrow in London on television when the future is up 24. Please stay with us. This is Bloomberg Surveillance. Good morning.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
You've been an advisor to the President of the United States on infrastructure and manufacturing, but on infrastructure, you've been involved with the legislation that was passed not long ago. Why is the United States infrastructure so terrible compared to so many other wealthy countries?
I have been around U.S. politics like you for a couple of decades and have served a variety of presidents from the different parties. And the attitude in the United States is obviously to keep taxes low and keep the public spend under control. And the word control is interesting, but that stops forward thinking in terms of planning. And therefore, the short-termism around our fiscal policies has hurt us. I mean, in essence, infrastructure is a long-term return. And to get a long-term return, putting it into private hands is one way of doing it. But really, the public side of life has to be willing to do the forward spend. The forward spend on airports and roads and EV charging stations has to come from the public domain. Now, raising taxes to spend money on infrastructure means you've got to trust the people doing the spending. And I think the public-private model is the way to go there, which is actually create an infrastructure bank that is U.S. public sector owned, that has private sector matching funds. I think that sort of breakthrough has yet to occur in the United States. So where we go is tax and spend, which unfortunately one side of the aisle disagrees with.
For parents and anyone out there who still doesn't quite understand, what exactly are kids doing on Roblox?
Kids on Roblox aren't just playing, they're learning, they're hanging out together. When they can't be together in real life, they're hanging out on Roblox. They could be playing hide and go seek. They could be pretending they're running a store or a pizza parlor. They could be making the next big game or adventure. So it's really a wide range of things, and it involves doing things together, pretending you're together.
Everybody's talking about the metaverse as something that's going to happen in the future, but there's an argument to be made that Roblox has already built a metaverse. What do you think?
I think we've started. There's still so much innovation to be done, and there's so much invention to be done in this category that it's mind-boggling.
This is Bloomberg.
Live from the City of London for our audience worldwide. How about that data? Equity futures up by 0.6% on the S&P. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Coming up, falling jobless claims pushing back against the gloom. Tech rallying, Tesla rallying after reporting better than expected results. And the White House slamming Chevron's $75 billion buyback. We begin with the big issue, the latest read on the U.S. economy.
We have seen very mixed signals.
This divergence between the forward-looking sentiment gauges.
Yes, there's been some weakness in the soft data in the U.S.
That's definitely visible in the manufacturing sector.
Like those ISM, like CEO confidence plummeting.
There is a slowing in the U.S. economy.
But we've yet to see that in the hard data.
Well, the hard data is looking good.
One has to contrast this with an extremely tight and a historically tight labor market.
But when we look at what's happening with the consumer, which is the backbone of the U.S. economy, we are seeing a clear loss of momentum.
Every piece of data comes in, it's gonna tell us part of the story.
Of course, the fourth quarter number does look pretty good.
This is not going to be an easy one for the Fed.
The bigger question is, are we able to maintain that momentum as we turn the calendar page?
Joining us to discuss is New Edge's Cameron Dawson and Samir Samana of Wells Fargo. Cameron, I want to go straight to you on this. This debate over whether we're about to enter a recession or not. How about those jobless claims?
It is just incredible that we're continuing to see such resilience and strength within the labor market, which just points to an economy that is more resilient than expectations and likely can continue to surprise to the upside in the first half of 2023. It's important to remember our comps are pretty easy from the first half of 22. That's where we had negative GDP prints. So what this means is that the economy is really not giving any reason to the Fed to cut interest rates in 2023, which just means that the Fed could likely be more hawkish than the market is expecting. And usually when the Fed is more hawkish than markets, you see weakness in equities and fixed income eventually.
I don't see that weakness this morning, not in equities. We're up 0.6% on the S&P, on the NASDAQ, up by more than 1 full percentage point. Samir, you anticipate that this recession could be imminent. Now, the sub-50 PMIs say, let's go. You're right. I've got to say, when I look at what's happening with jobless claims, they say no chance, no way, not anytime soon.
Yeah, I mean, look, that's the typical disconnect between leading indicators like those, surveys, and then kind of the coincident, indicators like unemployment. I think people sometimes kind of get carried away too much with the payrolls numbers because, again, those will kind of, deteriorate in real time as, companies start to actually go through the process of laying off those folks. Michael McKee just talked about how, look, Google's not even going to lay off people until April, and they just gave them notice, right? So in about 4 months, that's when that data will show up in the jobless claims, right? So I think you have to follow layoffs, and I think those are up quite a bit year over year. I think the other tricky part, too, is, I mean, look, we need a recession, right? That's about the only way, really, to get inflation under control. So, a lot of people might be thinking about recession in kind of a negative way. We think it's one of the only few paths towards higher markets.
Samir, can we just pick up on the economic data? You mentioned that claims are a coincidental indicator. If I look at the PMI, it's been sub-50 since the end of last summer. I look at claims are falling, they're not climbing. What do you make of that? There's a disconnect there. What explains it?
I think the biggest thing is the participation rate, right? You're still continuing to lose people from the labor force. So I think companies are hoarding labor, but I think the tricky part now is as earnings expectations start to come down and companies are actually, finding themselves losing some momentum on the earnings side, I think that's when they will finally kind of relent and let people go and in the hopes that they can get them back probably later this year or early next year.
This is a real debate right now. Deutsche Bank's Binky Chowdhury weighed in on some of this. He labelled this the recession being pushed out and the prospect that this equity market rallies even further. He said there are 3 well-known reasons: strong household, corporate balance sheets, companies hesitant to fire soon after widespread difficulty in hiring, and excess savings accumulated around the pandemic. And then he said this, and I think this is a really important line: real household income, after falling for a year, has grown solidly for the last 5 months, supporting real private consumption, which has continued to grow within its pre-pandemic up channel. Cameron, can I get your thoughts on that?
Yeah, I think this is the Neil Dutta effect. He's been talking about how real incomes have been accelerating, not decelerating, and you typically don't see that at the beginning or when you're going into a recession. And I think the real question is why we're starting to see some of this reacceleration. Of course, inflation is fading, but we have to note as well that financial conditions have been easing rather materially over the past couple of months. And maybe this is one of the reasons why we're starting to see this reacceleration in some parts of incomes. And financial conditions today are now easier on the Bloomberg index from where they were in March of 2022, which means that it's a big question of how much the Fed will push back against that financial conditions easing, mostly as we go into the Fed meeting next week.
Samir, what's the biggest challenge to that view?
I think the tricky part from here is, I do think you'll get probably a little bit of a tick up in long rates. I think with the Fed continuing to at least keep the optionality live with respect to additional rate hikes, the market pricing in something sub 5%. I think that's probably the biggest risk to markets is that long rates start to kind of tick back up. And, as we all know, that's what goes into a lot of cash flow and dividend discount models.
Got to stay on top of the price action this morning, about 25 minutes away from the opening bell in New York. Equities up by more than 1% on the NASDAQ. Tesla absolutely flying. The stock in the pre-market up by around about 10%. We'll pick up on that story around the opening bell. Off the back of the jobless claims data, the GDP data, upside surprise after upside surprise through much of this morning. Let's get to Mike McKee for more. Hey, Mike.
Hey, John. I think the numbers, at least from the jobless claims, are what sort of grabs everyone's attention today. 186,000 down from 192,000. But GDP is what people were waiting for in terms of the overall numbers, and it comes in better than expected at 2.9%. The price index, which I don't have up there, but people will be looking at 3.5%. The question there is, what's the December contribution? We get that tomorrow, so we'll be looking for that. The initial jobless claims numbers I gave you, durable goods orders, 5.6%, ex-transportation, 0.1%. That was a lot of this number was Boeing, and I had it backwards earlier because I thought it was Boeing having a bad quarter. Boeing actually had a very good quarter, non-defense aircraft up 115%. Capital goods, though, down 0.2%. That's business spending. And let's go to GDP. Here's what we saw in terms of contributions to GDP. Consumers still very strong, up 2.1%, and that added 1.4% to GDP growth. Business spending, though, 0.1% to growth. Businesses really dropped off here in the fourth quarter, and that may be a sign of nervousness about what's going to happen. Government spending was up, but not as much as people thought. Defense spending not as high as thought, replacing stuff that we sent to Ukraine. Trade was 0.6 contributor, stronger, and inventories went up. There was a thought that inventories might have fallen. So you can see the impact over the past year in terms of what contributed. Now, GDP, the trend has been reasonably strong here. We saw a couple of bad quarters in 2022 that were largely driven by trade and inventories. Now that those are out of the way, we are seeing growth for the year. The GDP was up by 2.1%. And after those two bad quarters, you'd think things would continue to be bad, but instead a rebound. So the question is, what happens going forward in 2023? The forecasts are not strong, John, but maybe we'll be surprised as we have been with claims.
And Mike McKee, great work as always. I think we're all surprised by that. 186,000 on initial jobless claims. Cameron Dawson mentioned it. Renmax, Neil Dutta talking up the re-acceleration in this economy. Last week, Mohamed Al-Arian on this program saying the Fed should hike 50 basis points. He wrote about it this morning on Bloomberg Opinion. He said the following: while it is true that the Fed is walking through a dark room, it is also true that time is of the essence. The Fed does not have as much time as it wishes. It can maintain flexibility and regain some credibility with a larger than expected increase next week. Cameron, you mentioned the Fed next week. Can we pick up on that theme? Why not 50?
I think why not 50 is simply because they have messaged 25 so clearly in all the Fed speak leading up to it. But I think that you could make the argument that 50 would be appropriate simply because the way that the Fed is going to measure its success in this tightening cycle is essentially the time between their last hike and their first cut. And so getting these hikes in quickly really would get to the point where they think the policy would be restrictive enough to slow down growth. And the problem is it's just not showing up in the numbers yet. And we're starting to see something that could even back them into a corner even more, which is that gas prices are starting to climb again. They're up 12% over the last few weeks. That's the biggest increase since the peak in gas prices back in June. And that will feed into month-over-month inflation data. So as we look forward to January and February CPI data, we wouldn't be surprised to see that start to reaccelerate, which means that March is a very important meeting for the Fed because maybe they can't point to this deceleration inflation data like they've been pointing to recently.
Cameron, this is going to be a big problem potentially if it plays out that way. We heard from Neil Kashkari of the Minneapolis Federal Reserve at the start of this year in a blog post, and it's this quote from him that I don't think many people in this market buy into. He said, the second step of our inflation fighting process, as I see it, will be pausing to let the tightening we have already done work its way through the economy. I have us pausing at 5.4%. Cameron, this market doesn't buy that, does it?
Absolutely not. And the market's pricing in 50 basis points of cuts into the back half of next year. So when the Fed is telling us, and they keep repeating this quote, history warns against cutting too soon, the market is trying to call the Fed's bluff. But we have to remember that the bond market has not been correct about the pace and the path of Fed hikes. If we go back to this time last year, for the February 2023 forecast for the Fed funds rate, the bond market thought it was going to be just 1%. Next week, it's going to be up to 4.75%. So the bond market has been off base. And I think the reality is that those rate cut bets that are priced into the back half of next year, as they get unwound, as the Fed sticks to its guns on wanting to keep rates higher for longer, likely could put upward pressure on yields that we have to think about as we move through the year.
There's another aspect of this rate cut debate that I think we need to talk about a little bit more, an extra dimension. We mentioned it a little bit earlier this morning on Bloomberg Surveillance. There is a question, Samir, as to why we'd be pricing in rate cuts here. Are we pricing in rate cuts because we think there will be a soft landing that doesn't require higher rates? Or are we pricing in rate cuts because we think there's going to be a hard landing that requires looser policy? Which one is it?
Yeah, I mean, I think that, look, it's more history, which usually, you know, by the time you've raised rates this much, something has broken. It's just this time around, you know, to all the points that we've already made, right? Things are just much more resilient. So I think the market is kind of probably relying a little bit too much on history. This time around is a little bit different. We are emerging from a pandemic. You have a lot of consumers globally. I mean, look at the Chinese who are just now able to kind of go back out, that are kind of revenge spending or whatever you want to call it. So for all those different reasons, the Fed's just not going to break anything at around 5% Fed funds. So it doesn't lay the groundwork for those quick rate cuts that the market expects. It's probably one of our key themes for this year is that the Fed will hold the line.
Samir, you are bearish on risk assets, aren't you?
In the first half, we are, but we do think in the second half there will be enough progress on inflation that the Fed can start to consider rate cuts at the very, very tail end of 2023, and the equity market, being kind of the forward-looking animal that it is, will start to kind of sniff those out in the second half.
Samir, what do you make of the price action year to date then? I know it's early days, it's only a couple of weeks, but what do you make of it?
You know, we've really been chopping, you know, since kind of June of last year. We've kind of been right around 4,000, give or take, you know, 200 to 300 points. So, you know, I don't really take anything away from it other than you've got these two, contradictory forces with the markets wanting to call a premature end to the bear market and the Fed saying, no, it's a precursor for inflation coming to where we need it to be.
We'll talk about those contradictions in just a moment. Samir Samana there and Cameron Dawson. Equities right now up by 0.6% on the S&P, about 17 minutes away from the opening bell. On the Nasdaq up by more than 1%. Here's a contradiction. Jobless claims, sub 190. Coming up, another wave of layoffs gripping corporate America.
You're seeing quite a lot of layoffs in the tech sector, the financial sector at the moment, which is a degree of right-sizing following a fairly artificial surge in 21-22.
That conversation up next.
Amazon acquired Zoox back in January 2020 for what reports suggested was $1.2 billion. Since then, the company has revealed its Zoox vehicle. This is, I think, a rectangular passenger-focused vehicle with no driver's seat or steering wheel. How would you describe it?
We describe it as a purpose-built vehicle, but it's really a robo-taxi. That's its purpose. And essentially, it's about transporting people from point A to point B on demand in the most effective, cleanest, and most enjoyable way.
So why won't you call it a car?
Because a car is, there's an inference that there is a driver. Whereas in our robotaxi, there is no manual driving. A human cannot really drive it to transport passengers. So we want to make sure that that mindset, that shift, that distinction is clear.
Good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets. China open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power. This is Bloomberg.
We're doing a very targeted restructuring. 9 months ago, of course, everyone was expecting a deep recession everywhere. Now I would rather call it a cautious optimism. Now, the environment, is not great out there. But again, technology, when you talk about process automation to offset inflationary pressure, supply chain resiliency, this is where we are super relevant, and this is why we are confident about the year to come.
Layoffs continuing to pile up in the tech space, this time IBM, SAP, and Lam Research, all joining the growing list of companies reducing headcount in an effort to rein in spending. Katie Lyons all over the story the last couple of months. Hey, Katie.
Hey, John. Yeah, it has been so often that I come on here and talk about a new company joining this list, which has gotten increasingly long. Just in the last 24 hours, as you say, 3 more being added to it. IBM is cutting about 1.5% of its workforce. That equates to about 3,900 jobs for Lam Research, which is, of course, a big maker of chip manufacturing equipment. It's cutting about 7% of its workforce, about 1,300 jobs. Then SAP, who we just heard from, is cutting about 3,000. That brings the total number of tech companies that have announced job cuts in 2023 to roughly 20, including Amazon, Alphabet, Microsoft, Salesforce, Spotify, a few in the crypto space as well. There are others too. Together this year, they have collectively announced nearly 60,000 layoffs already, and it is January 26, and that's on top of the nearly 100,000 job cuts announced by the sector in 2022, which was up 649% from the year prior. And as you say, John, all of this is an effort to rein in costs as their growth slows down, and the realization dawns that they overhired during the pandemic boom of the last several years. The question we've all been asking, and as you were talking about just moments ago, is when is this going to start showing up in the economic data, given 186,000 print on jobless claims and an unemployment rate currently at 3.5%, which has gone down over the last couple of months. But for certain tech-heavy areas like San Francisco, for example, we have started to see that unemployment rate locally tick up. And of course, these are freshly announced cuts. That means they haven't actually hit yet. We can expect that number will go higher, John.
It's a good point, Kayleigh. Mike McKee was talking about that in the last hour as well. Katie Lyons there on the breakdown of jobs in big tech. I want to come back to you, Cameron, on this story. Can this happen? Can this take place in isolation? Can you get these big cuts in one industry without it bleeding out into the rest of the economy?
Well, I think what's dampening it right now is the fact that job openings remain so high. If we look at job openings, there's still about 3 million job openings higher than the pre-pandemic peak, which might be the reason why, if we're seeing layoffs today, folks are able to find new jobs rather quickly, and that is dampening then the impact into the broader numbers. But as you asked, the key question is contagion, because that's what we've typically seen in prior cycles. It starts in one area and then slowly spreads its way to the broader economy. So we'll have to watch it closely, but for now it's job openings that are keeping us from seeing it show up in initial claims.
The Cameron tech got hammered, absolutely hammered in the last 12 months. Year to date, though, anything but. The Nasdaq's up about 8% year to date. Right now, Nasdaq futures up by 1.2. What do you make of the rally in big tech so far this year?
Yeah, it's a last shall be first rally because it lagged so much in 2022. And we also saw really extreme outflows from tech ETFs going into the end of last year, which just sets us up for light positioning and low expectations, which can give you a relief rally. Now, the problem with tech overall is that from a technical standpoint, if we're looking at the charts, they remain in downtrends. And now a lot of these names are very overbought into downtrends, which is not a very good position to be in. So we're doubtful that this tech rally has a lot of legs further. It certainly has gotten closer back to trend after being oversold. But we think the liquidity environment, meaning the Fed remaining tight, not cutting interest rates, not flooding markets with liquidity, simply doesn't support a lot of relative multiple expansion for tech names that still are trading at a pretty big premium to the market. So we'd be cautious to chase.
Samir, is this just a relief rally?
You know, we like tech. We like tech. We like energy. We like healthcare. You know, we think this is the environment where you want to try and kind of go towards those areas where there's more durable demand, especially, again, if our base case is a recession. You know, that being said, you know, I think there are parts of, you know, the market that get lumped into tech. So consumer discretionary, right, where you've got electric, you know, and hybrid vehicles, where you've got e-commerce, comm services, right, search, you know, social media, et cetera, that gets lumped into tech sometimes. So, you know, we're playing tech proper versus comm services and consumer discretionary, which we think will be much more harder hit by a slowing consumer and that multiple re-rating.
Samir, why won't energy? Why won't that get hit?
So it probably does get hit from the standpoint of people will consume less, but we think we're in the early innings of a bull super cycle, and we don't want to get too cute with respect to timing. We think energy has proven itself over the last year or two as being one of those things that we just can't do without. And, you know, I think it's been proven now that some of the greener efforts just aren't as reliable when kind of the rubber meets the road. And so we think you'll have fossil fuels be a very important piece of the energy infrastructure for some time to come.
And Cameron, final word on that. Do you agree?
Yeah, we think the reason you own energy in portfolios is a little bit different in 23 versus 22. 22 was all about pure upside, big earnings growth, and being very cheap in its valuation. In 23, it's all about a hedge. It's all about if we see oil prices rise, it likely means that we're going to see inflation reaccelerate, which could be bad for other parts of the portfolio. So we like energy as a hedge against that because it's one of the few sectors that would do well in that potential scenario.
Did well last year, that's for sure. To the both of you, thank you. Cameron Dawson there, Samir Samana. Just responding to the data we've had in the last 60 minutes or so. Jobless claims, 186,000 off the back of some of that. Equity futures right now up 0.75% on the S&P. On the NASDAQ up by 1.25%. Treasury yields at the front end, yields higher by 3 basis points on a 2-year to about 4.156%. Coming up, the morning calls, and later, Tesla providing some relief following a string of difficult months and disappointing results. That conversation still ahead with Pierre Faragut of New Street Research.
A book about YouTube now. Why'd you do this project?
Yeah, YouTube is this kind of a sleeping giant in social media. Someone described it as like this iceberg that no one ever really talks about as much for a variety of reasons. I see YouTube as both the past and now future of social media, and it was the first company to pay online broadcasters and invented the creator economy. And now we're seeing with TikTok, Instagram, Snapchat, are all moving in this direction. Social media is no longer your friends and family and your acquaintances. It is influencers. It is celebrity. It is a game built around commerce. And this is a world that YouTube very much created.
Should we be telling Odd Lots listeners to like, comment, and subscribe? Other podcasts do that.
I mean, it's an effective call to action.
Okay. All right, everyone, like, comment, and subscribe on Odd Lots wherever you find it.
When innovation strikes, Bloomberg Technology is there with the news and analysis you need. Every weekday, only on Bloomberg.
Thursday morning, early days, but equities looking good here on the S&P, up 0.7%. On the Nasdaq, up by 1.2%. Let's get you some morning calls. First up, UBS downgrading Pfizer to neutral, $47 price target, seeing limited upside to the pipeline and overly optimistic profit estimates. That stock is down 1.6%. Your second call from Wells Fargo, downgrading Hyatt Hotels to equal weight, expecting the recent rally to start fading after jumping 25% this year. That stock's down 1.3%. And finally, Wolf Research raising its Tesla price target to 185 after earnings, saying management provided encouraging messages on growth and margins. That stock is absolutely flying up more than 10%. Coming up, we'll catch up with the bull. New Street's Pierre Ferragut joins us at the opening bell with more on Tesla's post-earnings rally. That conversation just around the corner.
The innovation agenda is going full speed on mitigation. That's where, you know, there's 100 companies, Breakthrough Energy's funded. There's
by mitigation, you mean mostly energy. You mean everything to do with energy. You mean generation of energy. You mean batteries. You mean transport. You mean all of the new, and there's some renewables that are already traditional, but more that need to come out. So that's the package that you're talking about, mitigation? Yeah. Or are you also talking about agriculture as mitigation?
Yeah, so every area of emissions, you know, the world tends to focus on passenger cars and electricity. That's not a third of emissions. And so the focus on the easiest third, you know, now 4% of new cars are electric, you know, so that's the field that we're furthest along. About 4% of energy generation is wind and solar.
The top names in business are on Bloomberg.
Different countries are at very different places, so you actually cannot speak in generalities. We expect to see a rolling series of country recessions, but the vulnerabilities that amplified previous recessions around the world are not present. That omens well for a mild recessions when they come.
Nobody covers business like Bloomberg, your global business authority.
From New York City,
in London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai. Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers Jobs Day like Bloomberg.
23 seconds away from the opening bell over in New York City. Check out the price action. A lift in this equity market, up 0.7% on the S&P. On the Nasdaq, absolutely flying here today. The Nasdaq 100 year to date coming into today's session up by around about 8%. We're looking to add some weight to that at the open. The Nasdaq right now at 1.2%. There's your opening bell. Switch at the board and get to the bond market. Post GDP Post-jobless claims, that claims number, just wow. To see jobless claims drop to 186,000 and push back against the gloom. Yields right now up 3 basis points on a 10-year, 347.44. Euro dollar a break of 109, just about 108.99, down to by about 0.2%, just about holding on to a 109 handle right now. Crude at the moment, positive 2.3%, $82 a barrel on WTI. At the open then, about 25 seconds into the session, equities positive across the board, up 0.7% on the S&P. Looking at the Nasdaq, up by 1.3%. Tesla rising 11% at the opening bow. That's the stock to watch. Higher for a 5th consecutive session after reporting better than expected results. Elon Musk reassuring investors over demand, saying thus far in January, we've seen the strongest year-to-date orders ever in our history, almost twice the rate of production. Ed Ludlow on the West Coast following this one. Morning, Ed.
Yeah, good morning, Jonathan. Tesla at its highest level since December 13th. 5th straight day of gains, the longest streak since September of last year. And as you said, actually what's so interesting is that we're now 50% plus on Tesla, higher from our January 6th low, which I find astonishing, the gains we've had in momentum on this stock in such a short space of time. Let's get straight to the numbers. On the bottom line, adjusted earnings per share of $1.19. That was on revenue of $24.3 billion, both above expectations. And as you said, there was fighting talk from Elon Musk and other management about the demand picture, or they did acknowledge that in 2022 at least, a lot of their issues, both on the production side and on the delivery side, were in China. They reiterated and continued to state this ongoing above 50% compound annual growth rate, which is compared with its 2020 base, and reset expectations for 1.8 million units in 2023. On the call, Elon Musk said that 2 million units was possible, which is more in line with what the street sees, at least the more bullish elements of the street. Some analysts out there this morning saying actually the 1.8 million guide is conservative. Elon Musk said on the call that they're not committing to 2 million. It's just that it's possible should there be no supply chain constraints and no headwinds. That said, he also talked about the economy and said that a deep recession, a potentially deep recession, is possible in 2023. You take that into account in the demand picture.
Stock is up more than 10%. Ed Ludlow, great work as always, buddy. Thank you. The stock looking to reclaim a $500 billion market cap. It's a very different story for IBM. Shares extending declines on a cash flow miss. This coming amid plans to cut nearly 4,000 jobs. Abby has more. Hey, Abby.
Hey, John. Yeah, well, the biggest headline here probably was about the job cuts, that familiar headline that you and Kelly have been talking about so much, so frequently. 3,900 people worldwide were cut. Now, it does have to do with one particular unit. It's a little more than 1% of their global headcount. And in addition, they are actually continuing to hire in high growth areas. So there are two different ways to look at this layoff, maybe trimming again with relative to that one unit. Now, relative to the quarter, it's kind of interesting because I would say that the number that, or the word that describes it best is flat. Relative to both the top and the bottom lines, if we flip up the board, we will see that numbers came in for both revenues and EPS just a little bit above what was expected. But that free cash flow miss that you were talking about, probably having to do with FX, it was a solid miss there. On the other hand, the 2023 free cash flow estimate is better than expected, or what they gave is better than expected. As for finally revenues, it's an interesting thing, John, because you wouldn't expect this for a stock that's down. They actually, in 2022, put up their best annual growth since 2011, 5.5%, 2 years of up growth. So who knows? Maybe this stock will pull something similar to a Microsoft, a Tesla, and some of the banks, where bad results, or even in this case, mixed results, will be looked at differently as the day goes on or in the days ahead.
For now, it's struggling. The stock's down by 3.7%. The broader market's still doing okay. 4 minutes into this, up 0.8% on the S&P. On the Nasdaq, up by 1.6%. We had earnings from a host of airlines through the morning. Southwest and American Airlines delivering a mixed outlook. Kaylee Lyons has more. Hey, Kaylee.
Yeah, and it wasn't just them either. You also had Alaska and JetBlue reporting. Alaska a little light, JetBlue beating a little bit. You do have a mixed bag when it comes to the stocks. The big outperformer, though, being American, which is up about 1% here in the first few minutes of trading. It was less about the quarter and really, for me, more about the forecast, because it kind of blew it out of the water. They expect earnings for the full year 2023 to be between $2.50 and $3.50 a share. Analysts were only looking for $1.89. So really just chalk that up to demand being strong, capacity being constrained, and that supply and demand supply-demand dynamic equating to higher fares and higher profit. To give you a sense, in the fourth quarter, Americans' passenger yield was up 28% year on year. For Southwest, though, it is a less pleasant story. They had told us a loss was coming because of that holiday fiasco in which we saw the cancellation of nearly 17,000 flights, but the loss was wider than expected, 38 cents per share. Analysts were only looking for a loss of around 7 cents, and they're expecting a first quarter loss as well as the fallout from the episode extends. Southwest says revenue in the current period will be reduced by as much as $350 million through a combination of ongoing cancellations and reduced bookings. So a hit on the top line, plus they're expecting more cost pressure as well. Non-fuel costs, they say, will be up as much as 4% in the period. They do, though, see a light at the end of the tunnel. They said March bookings and fares appear strong, so they're encouraged by those trends. And again, that does come back to the idea of still strong demand for air travel. That has helped these stocks outperforming as well. Year to date, so in just a couple of weeks, the Super Composite Airlines Index is up about 20%, and that is well outperforming other stocks in the transport space. John.
The performance of those names has been unreal, unbelievable. Katie, thank you. Southwest this morning down a little more than 3%. Not a fun time this morning for Southwest investors. Not a fun time over the last month for people traveling with the airline. I want to turn back to Tesla. The stock flying. New Street's Pierre Fadagu doubling down on his high conviction call, maintaining his buy rating and a $320 price target after results, and saying the following: demand is not an issue. We expect unit costs to improve materially this year, driving margins back towards 25%. The stock has a very attractive valuation, offering more than 100% upside potential, and we see material further upside beyond. Pierre, I'm pleased to say, joined us now. Pierre, let's start there. You like what you see?
Yes, I like what I see, absolutely. Can you imagine that Elon Musk stayed, they're booking 2 cars while they're producing only 1. And the big concern of investors that was completely understandable since September was like declining demand, getting a demand issue, price cut, something like that. And basically what we see is that Tesla played the game of making very highly visible, very well, advertised, very significant price cuts. And that created like a boost in demand. And what we start seeing now is that Tesla is already starting to slowly increase some of the prices to keep things in check. So we have a very significant price cut. That's what Tesla needs to continue to grow. It's all about affordability. Tesla will be able to sell at some point between 10 and 20 million units a year if they can keep reducing the cost of their cars. They've taken a significant step towards that. And what we heard last night is that the whole thesis is still playing out well. So number one, demand is back stronger than you could ever imagine. And number two, Zach, the CFO, really had very interesting comments about where he sees gross margin and unit prices landing on the back of these price cuts. It's above 20% gross margins, and it's on an average selling price above $47,000. That was a huge reassurance for investors to hear that color last night.
Pierre, if demand is so good, why are they cutting prices?
Well, that's the whole thing. You don't want to forget the 2 parts of the story of Tesla. Tesla is meeting unlimited demand as long as they continue to make their cars more affordable. So to give you a sense for that, John, last year, Tesla was selling cars for an average selling price of like $55,000. At that kind of price point, you have like 7-8 million units as a market globally. If you want to sell 20 million cars, you can't stick to that price point. You have to lower your price, not because you have an issue, competition putting pressure on you, but just because you need to make your product more affordable to expand the addressable market. And so Tesla needs to do that. So Tesla has no demand issue, but part of the plan is to keep taking prices down progressively over time. It's very important. Remember Apple, 2007, the average selling price of an iPhone was, take it or leave it, about $800. 5 years down the line, 7 years down the line, the average selling price of an iPhone was like $550, maximum $600. Apple took the price of the iPhone down very significantly. What was the result of that? They took volumes from 10 million units to 230 million units. And in the process, they had to take gross margin down from high 40s to mid 30s as well. But that was a good move, like moving from 10 million to 230 million units was a good move for Apple. So you have to think about Tesla as a technology product. And for a technology product, these price cuts made complete sense. It's very disturbing for people looking at the car industry because the car industry has not been doing that for almost 100 years, like innovating at that pace. But for a high innovation product, it makes complete sense.
Pierre used that word tech, and I think that's a debate right now on Wall Street, how to value this company as a tech firm or as an automotive firm. And that brings up the multiple question. Can you run me through where that 100% upside line comes from? What are your earnings for next year, and what multiple is on them to give you that potential upside?
Yes, of course. Very happy to do that. So if you look at the stock today, I mean today, maybe not today, but let's say more tomorrow, it was not trading even on 20 times the kind of earnings we expect for next year. So next year, we expect like $7.90 of earnings. We're slightly above expectations, but not significantly, like by maybe 10 or 20%, something like that. So we don't have like an out of common sense kind of expectations for next year. We just think Tesla keeps growing production, maintains gross margin in the 25% region, and mechanically we think they get there. And what we think is that, you know, historically, Tesla has been trading between like 60 and 100 times earnings. These days are behind us. You know what happened last year, like the long duration growth names like Amazon, like Tesla, like NVIDIA, and many others all have derated significantly. That's a reaction to increased interest rates. It changes the way you value long duration growth. But given this set of compares, we think a sustainable trading range for Tesla is going to be between 40 and 60 times earnings. And so what we're thinking is that by the end of this year, Tesla should get back to 40 times earnings. If they do say $7.90 next year, we have like a price target of $320. So it just still offers you 100% upside on where the stock is trading right now, as I see it on your screen.
That's constructive stuff. The stock's flying on my screen right now. It's up about 10%. Pierre, always great to catch up with you, sir. Hopefully we can do this next week and we'll talk about a different firm. We'll be talking about Apple this time next week. Pierre Farragut there covers both of those companies. Tesla up 10% in early trading about 12 minutes into this session. We're positive by 0.8% on the S&P, on the NASDAQ up by 1.3%. Coming up, the White House turning its attention to big oil.
House Republicans are using their narrow majority to force the American people to pay higher gas prices, just as big oil companies are amassing record profits.
We'll get the reaction down in Washington, D.C., and the case for cyclicals. That conversation up next with Barry Knapp of Ironsides Macro.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Is the chance of humankind to really understand itself. How much of that is true? How confident? Did you actually overachieve? Did you, back then realize that we would be using AI in many different jobs? Was it slower or faster than you thought at the time?
I think if I had a 35 or 40 year prediction task, I would have been more or less on track as to where we are today. But I would have predicted steady linear increase over time. But instead, the field had very minimal improvements until the last 5 or 10 years. Then it really took off. I think we ended up in the right place, but I was very wrong about the trajectory. To this date, we still know very little about how the brain works, but these machines are getting ever more powerful. And I feel in some sense, we did end up learning what human intelligence is by learning what it is not. If we exclude all the things machines can do better than us as what makes us unique in our human intelligence, then now we can rule out many, many things, because AI or machine learning has become so good at so many things that what's left must be the key aspects of human intelligence.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
The president spent the last 2 years, as you know, doing everything he could to lower gas prices for American families. House Republicans are using their narrow majority to force the American people to pay higher gas prices, just as big oil companies are amassing record profits.
Chevron announcing a $75 billion buyback program and provoking fresh attacks from the Biden administration, demanding more supply to lower prices. The White House writing in a statement the following: for a company that claimed not too long ago that it was working hard to increase oil production, handing out $75 billion to execs and wealthy shareholders sure is an odd way to show it. Team coverage starts right now with Bloomberg's Kelly Lyons in New York and AMH down in D.C. Anne-Marie, the latest.
Well, it's a feisty response, to say the least, wasn't it, Jonathan, from the White House? But you shouldn't be surprised. The Biden administration has been scolding oil companies for months about higher dividends, about share buybacks, and what many in the White House, and also those on Capitol Hill on the Democrat side, is that they blame the oil companies for a rise in gasoline prices. And they say that oil companies are profiteering from Putin's invasion of Ukraine, which led to higher energy prices. So, Jonathan, this debate that's been going on between the oil patch and the Biden administration is not letting up.
Well, let's put a number on it. Katie Lyons, across the oil industry, that number's huge.
It is huge. I mean, let's just talk about the number of this buyback figure for Chevron. $75 billion is triple the previous authorization from back in 2019. It is 5 times the current annual level of buybacks, and it's equivalent to nearly a quarter of Chevron's market value. So this is huge. Plus, they're upping their dividend by about 6.3% as well. Obviously, all of this fueled by excess profit, which has been fueled by higher oil prices, which, yes, are off of the highs from 2022. WTI is down about 7.5% over the last year, while energy stocks are up 39%, because ultimately, John, this is not just about crude prices. It's about product, gasoline, diesel, and those refining margins. That is where the profit comes from. We'll get those fourth quarter profit figures from Chevron tomorrow morning, but when you add up the full year for Chevron and the other oil majors like Exxon and BP, Total, etc., we are expected to see $200 billion almost in profit in 2022. That is 50% higher than the previous annual record. And instead of taking that profit and in doing more CapEx, investing in production, as might be more politically popular, they're funneling most of it back to shareholders instead, John.
Kelly, thank you. Kelly Lyons and Anne-Marie. We always do this with the oil majors, but never with, say, Apple.
I knew you were going to say
Apple
that.
Last year was $89 billion.
89.
AMH, I know, unpredictable. It's just always the way. Always seems to be the way.
Well, Jonathan, every day Americans see the price of gasoline the same way they don't factor in the price of an iPhone maybe once a year or twice a year.
Sure, I guess that makes a difference. Anne-Marie down in D.C. alongside Kelly Lyons in New York. Barry Knapp of Ironside's making a case for cyclicals this year, writing the following: until technology and other related sectors are more reasonably valued, the opportunity is in economically sensitive cyclicals. If you position using individual equities, we would limit exposure to large caps. If you utilize ETFs, we prefer equal weighted. Barry Knapp joins us now for a few minutes on this. Barry, let's pick up there. The cyclicals, energy, does it make a difference what the White House has to say about it?
I think that the concept that's lost presumably on the White House and on a lot of investors with respect to energy is that what shale fundamentally did was remove the bust from boom bust and make the return on invested capital far more stable. Prior to shale, if they wanted to drill new wells in the Gulf, for example, that could take 3 years. And if you shut that well down, it's gone until you want to drill another one, which takes 3 years. Shale can be started and stopped in a 3-week period of time. So that makes their returns far more stable, which is really does set the stage for things like return of shareholder equity to shareholders, because they just aren't going to have those bust scenarios where if the price of oil were to collapse, then they'd be up the proverbial creek. So I think that's one of the things that's kind of lost on investors and clearly the White House as well. But
well, Barry, let's talk about the broader market and the broader economy. This is not lost on either of us right now. Jobless claims are exceptionally low, 186,000. I've got to say, Barry, I'm surprised. We've got all these rate cuts priced in. I'm looking at the bond market, and we don't seem to be seeing a vicious move off the back of this. Let's say I told you that claims would come in the way they're coming in over the last few weeks. The 2-year's still at 416. It's only up 4 basis points on a day, Barry. What do you make of that?
First of all, continuing claims have been rising fairly steadily. I know you guys had a conversation with Mike a little bit earlier about potential seasonal adjustment factors, but I think the right way to look at the labor market is the way Brainerd appears to be looking at it, which is if you look at total labor income, total hours worked times average hourly earnings, there's a real deceleration going on. Now, it hasn't resulted in significant layoffs via jobless claims as of yet, but that labor income was 10% nominal at the start of the third quarter, down to 6 and change by the end of the fourth quarter. So you either work people fewer hours and pay them less, right? Because average hourly earnings are coming down as well. So labor income really is slowing, and I think the market sees that. I would push back on the rate cuts later in the year because I think inflation is going to prove more intractable around 3% than the market expects. However, it's clear the labor market is clearly softening from the perspective that I just gave you, which is the broadest perspective.
Sure. So, Barry, where does that leave your call on treasuries going into next week for the Fed? Are you tempted to short them or stay away?
I am for sure. I mean, 10-year real rates at 125 basis points is only into the middle of the zone as to where they were throughout most of last business cycle when the Fed was accumulating treasuries. So, and break evens down at 2.25%, 2.3% on the 10-year part of the curve. That to me looks too low. So I think that fading the Fed, which is counterintuitive, right? Because I think we're looking at 25 and done. I don't even think we'll get a March hike because I expect the labor market to deteriorate further. But then I think that's going to cause the curve to steepen out, the back end to really underperform. And that to me would probably be a pretty good trade once we get that final maybe push higher in treasury prices, lower in yields after the Fed meeting next week.
25 and done. There's a call from Barry Knapp of Ironsides. Barry, it's been too long. Let's catch up soon. 25 and done, the call coming from Barry for the Federal Reserve next week after seeing jobless claims come in sub 190, 186,000. Phenomenal stuff. This is going to be the conversation going into next week. What do you follow? What's happening with claims or what's happening with PMIs? Sub 50 claims in and around 190,000. Coming up, your trading diary. Equities up 0.4 on the S&P. Your trading diary's up next.
And says, I want to be Ari Emanuel when I grow up. What should somebody do to get into the talent
agency business or the business you're in?
Well, it's hopefully what I've taught my kids. You got to be intellectually curious. You got to be, you got to show up. And you know this like I know this. I got on a lot of planes. You just, even though that voice in your head is saying, oh God, I'm so tired, I don't want to do this. You got to show up. You got to be charmingly relentless. You have to build emotional endurance because there's no straight line to success. It's kind of all over the place, and you have to just be able to work through those things. And then I think one of the things that I do every week is I try to create serendipity.
25 minutes in, equities flying. On the NASDAQ at least, year to date, we had some more weight to that rally, up 0.9% on the NASDAQ. On the S&P, up 0.33% on the S&P 500. Coming up, your trading diary, new home sales at the top of the hour. Look out for that data in just a moment. President Biden discussing the U.S. economy from Virginia at 2:45 Eastern Time. We get earnings from Intel and Visa after the closing bell, followed by results from Chevron on Friday. And finally, PCE numbers and the UMich Sentiment Survey to close out the week. That is all still to come from the City of London. That does it for me. Thank you for choosing Bloomberg TV. Good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.
Amazon acquired Zoox back in January 2020 for what reports suggested was $1.2 billion. Since then, the company has revealed its Zoox vehicle. This is, I think, a rectangular passenger-focused vehicle with no driver's seat or steering wheel. How would you describe it?
We describe it as a purpose-built vehicle, but it's really a robo-taxi. That's its purpose. And essentially, it's about transporting people from point A to point B on demand in the most effective, cleanest, and most enjoyable way.
So why won't you call it a car?
Because a car is, there's an inference that there is a driver. Whereas in our robotaxi, there is no manual driving. A human cannot really drive it to transport passengers. So we want to make sure that that mindset, that shift, that distinction is clear.
Lisa, you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Businessweek about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands, and it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in Sari stores every day, also on TV, radio, newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number Fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with Number Fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the street, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million-peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for Number Fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance, per se, is to build up pressure on Pepsi. And so you see people marching in the streets. So we had mounted our own campaign, even in the U.S.
He flew to America and he hired 2 consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard, In America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113A, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi number fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's number fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning $1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as the coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. and it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic. They had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack on the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be a ploy by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker, but pretending to be a foreign person.
Federal investigators have detained 1 man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. he emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Venegold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Venergold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Venegold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Venergold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony, including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why. He may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Venergold as an opportunity to leave that troubled home. Venergold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Venergold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Gold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Gold didn't receive the harshest possible sentence. He was given 14 years in prison, but it's still a considerable amount in jail in Germany.
The threat of an asteroid hitting Earth is very real. If it's big enough, it's also very final.
These are very, very infrequent events. The probability is not zero, though.
A blinding flash of light streaking across the sky.
About 100 tons of space rock falls on Earth every day. Most of it is so small it burns up in our atmosphere or lands unnoticed away from major populations. No human in the past 1,000 years is known to have been killed by a meteorite, and according to NASA, no large object is likely to strike the Earth any time in the next several hundred years. However, one thing is certain: we haven't found them all.
There are thousands out there, and we don't know where they are.
There are a lot of asteroids in our solar system. They number in the billions.
Scientists all over the world are working toward detecting and deflecting the most catastrophic of natural disasters.
The race is on to find as many of these objects as we can.
We have a way of calculating whether or not an asteroid is potentially dangerous or not.
I mean, I think it's something worth investing in. It's our existence at stake, right?
Amy, let's get this one out of the way. It's probably the question you get asked the most, but how scared should we be?
Asteroids and comets are a natural hazard that's out there like a lot of other natural hazards. These are very, very infrequent events, these collision events, where an object actually impacts the Earth. The most important thing that we need to know about asteroids is, when the next impact is going to happen and how bad it will be. What we know is that an object that's about, say, a kilometer across is capable of causing very, very wide devastation across the planet, really, truly global devastation. The object that wiped out the dinosaurs was somewhere in the neighborhood of 5 to 10 kilometers across, so even bigger than that. At a kilometer, it's still going to be very bad and it will have global effects. For objects that are capable of causing what I would call sort of regional damage, kind of a large major metropolitan area, a city and its surrounding environments, sort of around 100-ish meters. It depends on the details of the composition and so forth.
By the 1980s, NASA was cataloguing near-Earth objects. In 1994, stargazers watched as comet Shoemaker-Levy 9 hit Jupiter. The resulting zone of chaos was estimated to be as large as the Earth, and the event became a turning point in the search for asteroids and comets in our solar system. In 1998, Congress tasked NASA with finding 90% of asteroids and comets 1 kilometer wide or larger. Soon after, Hollywood blockbusters Armageddon and Deep Impact brought attention and fear to the masses.
The great news is that the vast majority, more than 90% of all the really large 1 kilometer near-Earth objects have been found. The challenge now is working down to these smaller sizes that are still quite capable of causing a lot of damage, but they're just harder to spot because they're fainter, they're smaller.
Can you give us a sense of how many are out there in our solar system?
We know that there are a lot of asteroids in our solar system. They number in the billions. Most of them, however, are between Mars and Jupiter in what we call the main asteroid belt. This is a region of space where most of the asteroids in the inner part of our solar system live, and they stay there for many billions of years. There is another population, though, that kind of leaks inward and gets into the region somewhat close to the Earth, and we call these near-Earth objects. We think that there are millions and millions of near-Earth objects that are out there in the total population. As of today, we know of sort of around 20, 25,000, something like that. When we first spot an object, we really know very little about it. We just see something moving across the sky. So all you get is just sort of a handful of snapshots, just enough to be able to tell that this isn't an asteroid that we've already seen before. And then once we can calculate the distance to it, we can now start to make predictions about its true size. Is it large or is it small? So we have a lot of information that we have to get pretty quickly to really understand what's going on.
Finding asteroids is just one piece of the puzzle. Planetary scientists are extremely skilled in determining the orbits and speeds of asteroids based on relatively small amounts of data. NASA runs simulations of the trajectories asteroids could take, which is useful but time-consuming. A team of scientists in the Netherlands have found a way that could buy us more time.
Our method is very quick. So you can very quickly get an assessment of whether or not the object is dangerous or not. If you look at the classical way of determining the danger of an asteroid, it may take days of computing time on very big machines to determine this hazardousness.
The current problem is that there's just too many asteroids out there to spend a huge amount of computational power on all of them. So the neural network allows us to focus on what really could go and pose a hazard to Earth.
A neural network is a computing system that mimics the way the human brain operates to find underlying relationships in a set of data.
By training the network in this way, you train it in recognizing those objects that are most likely to hit the planet. And once it's trained, you can apply this network to all the unknown asteroids. And then you can make a selection and saying, hey, these are the ones which appear to be having orbits similar to the ones which we know are hitting the planet. That doesn't mean that they do, but it only means that they look very similar to the ones we know they do.
What else did you find? Should we be particularly concerned about anything?
One thing that we did find is that our neural network was able to go and identify a handful of asteroids which weren't considered potentially hazardous, that when we went and integrated them forward in time, they came quite close to Earth.
We find a handful which were not detected before or not considered being dangerous before, and we think they are potentially dangerous.
It's very hard to simulate kind of going forward in time an asteroid that's going to hit Earth because, well, the Earth is really small. And space is really big, and then you have to have very exact parameters to shoot an asteroid that goes and hits exactly Earth. And then Simon had the ingenious idea of not even trying to do that and just launching the asteroids from Earth's surface and integrating backwards in time.
It's very hard to make it hit. So you need a lot of calculations which all end up in nothing. And the idea was then well, let's not do that. This is basically what NASA is doing. NASA is taking an asteroid, making multiple copies of them, shooting them all forwards in time, calculating their orbits, and then see what fraction sort of gets close to Earth. Not even hitting Earth, but getting close to Earth. And that they call it a potential impactor. So you calculate the solar system forwards in time for, let's say, 1,000 years. And then you launch asteroids from the surface as if you go forwards in time, would fall on the surface. You calculate them backwards to today, and then you get your orbital parameters of today's asteroids, which you know will land on the planet. And those you can use as known impactors and compare with all the other asteroids in the solar system.
Can simulations and AI, can those things fill in the gaps where perhaps telescopes and other imaging tools can't?
Absolutely. Since the observations get more complex, the physics gets more complex. And if the physics get more complex, the mathematics becomes more complex. And at some point, you can't solve your problems analytically anymore. And then this is where the computer comes in. Now we have this trained neural network. We have a way of calculating in a fraction of a second whether or not an asteroid is potentially dangerous or not, and therefore deserves more attention or more time to spend on for really finding out if it is dangerous.
When it comes to hunting asteroids, time is critical.
What we can do about a potentially hazardous object depends a great deal on what we know about it and how much time we have before the encounter. We'd really like to find them when they're decades away, because the more time you have, the more options you have, and the less energy it takes to move an object aside.
It also means we might not have to resort to launching a nuclear warhead at an asteroid. Until recently, pretty much our only choice.
That's an option of last resort, in my opinion, yes. We have lots of options available. You can just simply bump into the object and just nudge it out of the way. That's one possibility, and that's kind of, in a way, sort of the simplest thing to think about, just nudging it off its path a little bit with, a massive object, a spacecraft, let's say. It's just kind of like bowling, if you will. If you have a long time or a long stretch of runway in the lane, just a very small twist on the bowling ball will make a big change in where it ultimately ends up. Another option would be something where you take a very big, massive spacecraft and you park it next to the object and you use the force of gravity as a towing rig. That takes longer, though, and you need to be able to send a pretty massive spacecraft, and it obviously depends a lot on how big the asteroid is. Other options start to get more and more complicated, and they range from painting one side of the object a white color and painting the other side dark, and then letting the pressure of light sort of perturb its orbit.
In a departure from the lab and computer simulations, NASA has real plans to rehearse kinetic impact deflection. In 2021, the agency will launch DART, the Double Asteroid Redirection Test mission, which will intercept a 160-meter asteroid in 2022. Better to practice now before we have to deal with an actual threat. In the meantime, discovering asteroids is our best bet. Thousands of scientists and amateur astronomers around the world make up an informal network that survey the heavens. But that may not be enough. NASA wants more resources to map our solar system and better technology.
We need to ramp up our network of sensors, and also we need to just continue to strengthen our network of international observers so that we can get follow-up, because we find these objects when they're distributed all over the night sky.
Once we get more observations, we get better data, we can make better predictions.
If you look at the big impactors we have had in the last, let's say, 20 years, or maybe 30 years, 50 years, most of them we haven't seen coming. So the real danger, I think, comes from the objects we don't know about, and not from the objects we do know about.
This particular natural disaster, like a lot of natural disasters and like climate change, is a problem of the global commons. So the thing that we risk collectively is that it sort of then becomes nobody's problem, and nobody takes ownership over it. The asteroids are all over the sky. They just truly cross boundaries and borders with a second's notice.
I kind of imagine in the future, maybe lots of small satellites around the Earth that are always going and looking outward. I mean, I think it's something worth investing in. It's our existence at stake, right?
The pandemic has affected everyone in different ways. Some pass the time by baking.
Homemade sourdough bread. Do I need to say more?
Some chose to binge watch Netflix.
It's your game.
Or maybe you started a garden oasis in your backyard.
Next, I'm going to put my lettuces in.
But for millions of others,
I'm going to be posting stocks that will boom
They wanted to uproot the financial industry.
Let's just lock it on up and take $15,000.
Here's a stock that can change your life.
I see a stock going up and I buy it, and I just watch it until it stops going up, and then I sell it.
I have gained over $3 million.
I want some free money.
I don't think you can overstate the online communities or social media's influence on financial markets.
A large group of inexperienced investors who discuss their plans on social media platform Reddit have shaken up the stock market in a big way.
The stock that everybody's talking about right now is GameStop.
Video game retailer GameStop is set to continue their head-spinning ascent today.
The revolutionaries on Reddit are spanking Wall Street's ass.
The more these stocks go up, the more the big guys are getting creamed and losing billions of dollars.
This isn't a wealthy person's game anymore. Anyone can play it.
I took up a little bit of a new hobby, and I am interested in day trading.
As an investor nowadays, you don't have to look a specific way. You don't have to wear specific clothes. You don't have to be doing it from a trading floor on Wall Street in like a high-rise building in downtown Manhattan.
The narrative of what's driving the markets is no longer being held in secret offices in New York and Boston of privileged people talking to other privileged people. It's right out in the open. It's on Twitter, it's on Reddit.
From brokerage apps to Discord channels and subreddits to TikTok finfluencers. One of the last holdouts in the world of disruption, finance is next in line.
Investing should be as ubiquitous as shopping online.
That's Vlad Tenev, the CEO of Robinhood, the online brokerage app, talking about how he wants his app to disrupt the world of stock trading like Amazon disrupted the world of home shopping.
And I think that speaks to exactly the mission that a platform like Robinhood has, which is to democratize investing.
Robinhood was started in 2013 by Vlad Tenev and Baiju Bhatt in, where else, Silicon Valley, as an alternative to the big brokerages, but with one big difference.
As they were building the social network around finances for people, they realized that there was a gap in the market and that free trading could become something that they could bring to the markets, they could disrupt the industry.
While no-fee trading is industry standard today, it was unheard of when it was first introduced.
The online brokerage industry was really innovative when they came on the scene 10, 15 years ago, but they kind of stopped innovating where you haven't seen those commissions come down beyond $5 or $6 or $7. Robinhood think that by offering zero commission that they're going to push people onto this platform.
And on top of no-fee trading, the customers Robinhood was courting have been long overlooked in the world of finance.
So the typical customer of a Charles Schwab, for example, is putting a lot more money in that brokerage account than the typical customer at Robinhood. Even today, with all of its popularity, the median account size is about $240.
There's Fidelities and the Schwabs and the E-Trades of the world. They look down their nose at those kind of accounts. I don't want a $1,000 account. They're just a headache. I want a $100,000 account.
And this is key here, right? Because the thing about Robinhood that's different than every other single brokerage platform is how easy it is to use.
The design of the Robinhood app really has in mind a user who might be coming at this absolutely cold.
The fonts are very well sized, the shapes, the colors, all of that is something that the founders of Robinhood paid really close attention to.
And by creating an interface that catered to a newer investor, they were able to gather a pretty healthy group of customers. And by 2019, they had about 10 million customers.
Those 10 million customers were a huge success story for Robinhood, but no one could have predicted its explosion after the arrival of COVID-19.
Remain indoors to the greatest extent, and 100% of the non-essential workforce must stay home.
What we saw when the pandemic hit was the growth of Robinhood users absolutely turbocharged. And oddly, you saw this surge in interest in stock trading. Then they saw the absolute surge in 2020 in customer growth. And now, by many accounts, they have more than 20 million customers, which is pretty extraordinary. So the next step for them is to figure out how to monetize those users and how, even with their small account sizes, to get them to grow with the company and, as it releases more products, come along with them.
Robinhood would become one of the COVID economy's breakout successes. Robinhood traders, as they're called, became the shorthand explanation for the frenzy of often speculative retail investing after the pandemic lockdowns.
Kids wake up in the morning, they go on Robinhood. They're, in the shower, they check Robinhood. Kids are learning how the stock market works at 18 while they're at school, checking their phones in between classes because notifications pop up telling them what their stocks are doing that day.
With these new tools, millennials and Gen Z are investing in the market in ways their parents could have never even dreamt of.
That is sort of key when we talk about the divide between older and younger generations, is that the younger generation is exposed to so much more information and tools at their disposal to do what they want in the market.
The older generations, you never had the technology or the cost structure that you could play the markets like you can today. So you were stuck with giving your money to a professional investor and paying them a fee to do it.
When I speak to young kids, they tell me, I'm making mistakes, I'm losing money. I'm not a perfect investor, but I'm 18, and by the time I'm 30, which will be, 10 years from now, I'm gonna have interacted with the markets for a decade. And so it's a learning experience more so than anything else.
And you can look at it and you can say, wow, that's risk-taking, that's dumb, but if you could possibly shave 10, 20 years off your working life versus adding 5 years, I don't think you can fault people for that.
But Robinhood is only part of the puzzle. Sure, you can trade on it, but without research, information, and data, you're just blindly throwing darts at different stocks and hoping to strike it rich.
Wall Street forever has always run on what we now call narratives or memes. People telling rumors to each other have been around for 100 years.
On Wall Street, information is its own currency. Historically, either you had it or you didn't, and the people who had it had a huge advantage.
In the past, those narratives and memes didn't have a network effect. It would be one person telling another person over the phone. In fact, when I broke into this business in the 80s, a lot of people used to complain that they weren't on the call list to get those ideas.
Social media changed all of that.
Fast forward to 2021, that's being done on the internet now. And that's being done on Discord and Twitter and StockTwits and Reddit. And the impact is very similar, but orders and orders of magnitude larger.
As social media has played a bigger part in our lives, it's also played a bigger and kind of more important role in how people find investing ideas online and on these platforms.
How do those ideas spread? On TikTok. Yes, that TikTok.
Soon may the weatherman come to bring us sugar and tea and rum.
People aren't just going to it for sea shanty videos.
The personal finance hashtag on TikTok has garnered 3.5 billion views from its 1 billion monthly active users. By comparison, videos found under the cooking and health tips hashtag have 2.6 and 2.1 billion views respectively.
The trajectory of Robinhood and TikTok were literally on par.
What happened in the stock market this week? So the word of the week is expectations.
Absolutely essential that you guys understand the risks of shorting.
And Kayla Kilbride and Kyla Scanlon are two of those financial influencer TikTokers, also known as finfluencers.
I think people still care about fashion, they care about culture, but it's also like there's this big behemoth thing called the stock market that we really don't know a whole lot about, and it's gatekept behind the industry. And so people like want to unpack that. And so my audience is a lot of them are younger investors who are looking to hone their skills.
Tech in right up.
Kyla and Kayla are two of the more, let's say, professional TikTok influencers.
The Tesla ARK Bitcoin Biotech Risk Cluster.
I've been trading since high school, and it was a really interesting way for me to fill out my decision-making frameworks and to think about thinking. And I think that the more that we can have people thinking about finance, the better that we're going to progress as a society. I think it's a huge gap in our educational system.
If you're going to buy an option for a stock you think is going to go up, it's a call. So think of it like this. I made the options video where I was like, options are just like shopping. Rumor has it that this pallet's about to go up in price. So if I come in tomorrow, can I still buy it at said price? And a ton of women just like attacked that video and were like, you explain things so much better than my boyfriend or my professor, or like I could sit and listen to you all day. And I was like, this is what I was looking for.
But TikTok's algorithm does not reward calm and measured videos about responsible investing. It rewards this.
Watch this video for 30 seconds and you'll be rich for the rest of your life.
I try not to say the A word, the ALGO word, because TikTok listens to us.
The algorithm does impact how you feel. You know, you do notice which videos do better versus which videos do worse.
How do you catch someone's attention in less than 60 seconds? And how do you make it something that they're like, I need this in my life? Nearly impossible to do that in 60 seconds. But the people who perfect it are the people that you're going to watch and going to stick around.
And where people are sticking around? Reddit. And its nearly countless subreddits about finance. And by far the biggest one of those is Wall Street Bets.
There's a lot of social media platforms out there, but Reddit is like the social media platform for finance. Places like Wall Street Bets is where it all goes down.
Started in January 2012, it wasn't long before Wall Street Bets adopted a 4chan-like etiquette, leading to their tagline, like 4chan found a Bloomberg terminal.
We had all these unexplained stock moves, and we would be grasping for why stock XYZ jumped 20% in a day. And you would look at Wall Street Bets, and you would see people there talking about buying options in that stock, and it sort of, squared the circle, so to speak, and started making sense. And it was at that point that it was like, wow, we have to start paying attention to this.
Some people on the platform really spend tons of time, and others are just looking for entertainment and to have a little bit of fun, effectively gambling or looking for an outlet, trying to make a little bit of money.
Then on top of all of that, there were stimulus checks. Now, clearly this money is going to people who need to use that to eat, to live, but there's a lot of people who use this money to invest in the stock market.
And it's not just stock tips. People quote-unquote YOLO their entire life savings or stimulus checks on a single stock. They post what is called gain and loss porn, screen-grabbing staggering hits and misses on stocks for the entire community to see.
I am about to lose everything.
And while some of the people on Wall Street Bets are novice investors, the community contains multitudes.
In one respect, what it did show us among these network groups is they are very sophisticated. They're not a bunch of ignorant people talking to other ignorant people.
And this is where the pieces of the puzzle all come together to wreak havoc on Wall Street for a solid week in early 2021.
It's pretty clear that the combination of more people having retail brokerage accounts and trading apps and more people being stuck at home looking for some kind of entertainment and some kind of community online came together in this very singular way.
What came together is GameStop.
Let's go back to the beginnings of what happened with GameStop a couple of years ago. On the boards like Reddit and StockTwits, a lot of people were talking about GameStop as being attractive value.
Some of them are even, Wall Street alums who left the industry and now still have access to tools that they can use to improve their financial well-being and make very good decisions. And I think Roaring Kitty is a perfect example of that.
GameStop is one of the most compelling asymmetric opportunities in the market today. Really, I don't understand how you could disagree with that.
At the same time that this crowd was talking it up, The hedge fund institutional crowd didn't like this stock at all, and it had the largest short interest of any stock in the New York Stock Exchange going into late 2020.
Short selling is a bet that a stock price will fall, and it's a fairly simple concept. An investor borrows a stock and then sells it. The investor is betting on buying the stock back later for a lower price, before returning it to the original owner, pocketing the price difference.
What a short seller would tell you is that they almost act as a policeman in financial markets, or they're at least looking for companies that aren't what they say they are. And that can range anywhere from an outright fraud that some short sellers try to expose to just a company that's not worth as much as investors think it is.
The problem is, if the stock price rises, the short seller has to come up with the money to buy the stock back. And the more it rises, the more it costs. And that's what's called a short squeeze. And the hedge fund Melvin Capital was on the wrong end of that squeeze.
Melvin Capital lost over 50% of its money in the month of January alone, just from being caught in the short squeeze of the stock.
This is where the disruption comes in.
One of the most wild stories you're ever going to see. GameStop shares absolutely going nuts.
In less than a year, the company's stock has jumped from less than $3 a share to almost $350. Cheers, everybody!
Roaring Kitty has turned $50,000 or so investment into some $14 million.
Whoa!
Investors all over social media use the free trading app Robinhood to wreak havoc on Wall Street.
They're actually piling on into some of these stocks to really hurt the professional short sellers.
And they all used Reddit, Twitter, TikTok, and Discord to tell one another to keep buying and, quote, hold the line and not sell GameStop.
People are getting cheerleaded for jumping in, buying at the highs. They're saying, keep going.
And it was working too, until
Thursday morning, the trading app Robinhood sent out this tweet. In light of current market volatility, we are restricting transactions, including GameStop.
People were really angry.
Robinhood was supposed to allow the regular people to play the same game these big boys are playing. But instead, we were all taken for schmucks, and they screwed us.
Shares of GameStop are jumping again now that retail investors are being allowed to buy shares of the stock.
But what we learned is that when people organize online, they have the ability to disrupt the market.
And it was a big sign. The ivory walls of the institution aren't as powerful as maybe the institutions thought them to be. I don't know if pumping up GameStop was the best use of billions of dollars, but I think that as a signal to society, it was pretty interesting and powerful.
The GameStop saga was so impactful that both Vlad Tenev and Roaring Kitty were called in to testify before Congress to clarify each of their roles in the saga.
One thing that's emerged from the congressional hearings is that they're interested in how retail brokerages make money and whether they're keeping the best interest of their customers in mind, but it's pretty fuzzy as far as what they would actually do as a result.
While the frenzy around GameStop eventually subsided, it didn't take long for retail investors to find other areas to invest their money.
Take a look at Bitcoin going bananas over the weekend.
Bitcoin forms a brand new all-time high.
It was after GameStop started to drop that we saw Bitcoin really go up to over 60,000.
How much further does this rally have to run?
It's compelling to say that money shifted from one venue to the other.
While correlation doesn't equal causation, there's a chart out there showing an inverse correlation on meme stocks going down and cryptocurrencies going up.
There's definitely an aspect where people are making money on stocks and then moving, they're agnostic, they're not hedge funds. They can invest wherever the hell they want. It's a classic sort of momentum trade. They're going to wherever the winners are and they're willing to jump on and, ride it.
So whether it's meme stocks like GameStop, meme coins like Dogecoin, or entirely new ways to invest in art like NFTs, the new kind of retail investor is making its presence known.
Over the next 10, maybe 15 years, you're going to continue to see, whether by choice or by force, that baton go from older generations to younger generations. I don't think any single app is going to be the thing that disrupts. I think people are the disruptors.
How people get ideas about what to invest in has become increasingly entwined with social media. And as social media companies govern more and more of our lives, the fact that now they're tied in more intimately to people's wallets is something that we might want to understand better.
Usually what disruption, I think, means is technology comes in, whether it's blogs to the newspapers or online retailing to brick and mortar. They come in and they're in the same business, but they just do it in such a gigantic cost savings that it causes everybody to switch. Well, that's the risk that happens here, is that it's so much cheaper to just manage your own money. We're not there yet, but costs and conveniences are moving in that direction. So I'd say, Wall Street, you haven't been disrupted yet, but you could be in the coming years, and that the final chapter on this story hasn't been written.
Meet Bloomberg's own David Nicholson. Now, his happy place is out in the field, on the open road. But like the rest of the world lately, he's been working from home a lot more than he's used to. COVID-19 has prompted a massive urban exodus as professionals of every ilk yearn for more space to live and work. As a result, rural areas have exploded, and they're poised to experience a resurgence as more and more families pack up and leave the big city to try out life in the burbs. But there's one problem with that. Not all internet speeds are created equal. Anyone who might need to upload or download large files for a living may not want to pack up and move to that cabin in the woods just yet. Now, David's house isn't a cabin, but it is in the woods, and inexplicably, his internet is workable.
My internet is okay. I pay a lot for it. It's around $140 a month. The download speed's great, and the upload speed is terrible, which is really bad for my work because I have to upload these massive files. But I'm definitely one of the more lucky ones in this community. Just a few miles down the road, my buddy has awful internet.
It's usually under 2 down and under 0.2 up, so it's often unusable.
Some days it's around 1, and other times it'll drop down to about 0.2, 0.3.
I just want to be able to have internet at my house without having to go outside the normal ways of acquiring internet. It's really frustrating.
We're literally a few miles away from downtown, and it just cuts off.
This is a problem, and the solutions are not there yet, because getting high-speed internet in rural areas en masse is something our providers may simply not be ready for.
If your internet service doesn't have fast download and upload speeds, then you don't have high-speed harmony. You have.
Americans on average pay about $70 a month for internet at home. But in rural areas, it could cost a lot more for a lot less service.
So the pricing for a fixed wireless provider here can be something between $80 and $150 for about 25 megabits per second. However, gigabit service, which is 1,000 megabits per second and symmetrical, is running at about $119 a month or $130 a month.
That's John Paul. He co-owns Spiral Fiber, an internet service provider here in Nevada County, California. And for the past 10 years, he's been trying to bring an affordable fiber optic network to town. It all started when he applied to be part of the pilot program for Google's fiber service.
Across the country, civic boosters have been going to extremes, chanting, singing, and marching trying to get the search engine giant to look at their town.
The internet these days is crucial to be in the world, to be a part of the world, and to be connected to your community.
Google ultimately went with Kansas City, Missouri, which left Paul on a mission to get funding to lay out fiber optic networks for gigabit service. Over the next several years, he would attend conferences and pitch venture capitalists and apply for grants to make his vision come to life.
One of the biggest roadblocks to building infrastructure for the internet here in the United States are the existing large providers. They have their land staked out. They would prefer that nobody come in and compete against them. In 2013, we applied for a grant. We went down and met with the commissioners at the California Public Utilities Commission. It was an arduous process to get funded, but we finally did against all odds. We got a $16 million grant, and then we went out to seek venture capital.
Then, in March of 2020, the pandemic hit the world.
Everybody got locked down, and everybody came home, and everybody started using the internet. And I remember seeing on one of the local fixed wireless providers' websites, they've said, hey, we know you're all staying home, but please don't use too much video, and please don't use too much bandwidth. And I thought, that doesn't work.
The U.S. connectivity gap is far greater compared to countries that are considered its peers economically. Some developing nations actually have better internet than rural America, like in Kenya, which has a state-of-the-art fiber optic network fed in from their coastline. The American connectivity gap does largely affect rural areas that are either outside of service coverage or simply prohibitively expensive. This is Rebecca. She and her family moved to Nevada County just a couple miles down the road from David. They took for granted that high-speed internet would just exist in the area, and it's not something they even bothered to check on before buying their house. Turns out, all they got was dial-up.
We wanted to move where we had a little more space, room for the kids to run around, just be out in the mountains a little bit more. Having come from a bigger city area where Wi-Fi is pretty readily available, we hadn't really considered that in our purchasing of the house, whether that would be an option or not. When school started, and now that we are remote learning with our children and we're doing everything from home, we didn't have the option to do that at our house. So every day when school would start, we'd have to pack the kids up and we'd go to my in-laws' home. They have a little cabin up in this area that does have Wi-Fi already.
Rebecca's situation is the norm in rural America.
According to data from the Federal Communications Commission, just 4% of urban Americans lack access to broadband internet. That's compared to almost 40% of people who live in rural areas. But while that was the case, there were also racial and socioeconomic divides in terms of who had that access. In addition to that geographic difference, low-income African American students, Latino students, and first-generation college students were more likely than others to have only one device at home that's shared among multiple siblings and or lack access to that actual connection.
For most American towns, there's also a lack of competition, forcing internet prices up. And large providers like AT&T and Comcast aren't incentivized to expand service to these rural communities.
This is how Xfinity makes life simple, easy, awesome.
So in our area, we have a small imprint of Comcast, but they're not going to go out to the more rural areas. It's just not cost effective for them to do it as a large company.
In order to lay fiber cable, you're actually physically digging trenches into the ground. And for internet service providers, they're primarily focused on maximizing their profits. And so the fewer customers you have, in any square mile and the more fiber you have to lay, that's just kind of harder to pencil out from a purely economic standpoint.
AT&T